This is a friendly reminder that the 2024 Global Economy and Financial Stability Conference, Day 2, will begin around in 5 minutes. Please kindly be seated, and also we do provide a simultaneous interpretation throughout the conference. Please select your preferred language. Channel number 1 is for Korean and channel number 2 is for English. And also please scan your name tag at the registration desk to receive a luncheon coupon. And for those who need a special meal, please ask one of our staff at the registration desk. Thank you very much and be kindly seated. We're going to begin our second day of the conference in 5 minutes. Thank you. Distinguished guests and ladies and gentlemen, good morning and welcome. We'd like to begin the second day of the 2024 Global Economy and Financial Stability Conference. I'm Lee So-yeon, and continuing from yesterday, I'll be your MC for today as well. The co-hosted by the Ministry of Economy and Finance of the Republic of Korea, the Bank of Korea and the Korea Development Institute and the Reinventing Bretton Committee. This annual event is held back-to-back with the G20 International Finance Architecture Working Group meeting to enable a fluid policy dialogues. And the second day of the conference will be streamed live on YouTube as well, and I'd like to extend a special thanks to online participants. Thank you very much for sharing your valuable time with us. Today's conference will commence with a 3-session comments to the evolution of global financial environment and new international financial system. Now, without further delay, let's kick off the second day of the conference. The third session will be conducted under the title of the Uncertainty of Monetary Policy and Global Financial Stability. I would like to invite the chair and the speakers of this session. Ladies and gentlemen, please welcome them with a big round of applause. William Roos, the head of the Multilateral Affairs of Trade and Development Policies Department of Ministry of Finance, will be in charge of moderating this session, and we're going to have 2 speakers and 3 discussants will be joining us for this session. So please, Chair.
Thank you very much. It's a great pleasure to start this second day of this so important conference. I've been used to come because it's back-to-back with the G20 International Financial Architecture Working Group meeting, which is used to take place in Seoul just after this conference. So it's the third year for me to attend, and I have seen how important the topics we discuss are, notably for the G20 discussion. My role is only to moderate, but I would just like to give you some introduction regarding our topic about monetary policy, financial stability, and with that, how it has an impact on capital flows in emerging and developing economies, and what are the consequences on the financing conditions for emerging and developing economies, the cost of financing, but also the access to financing, whether the markets are open or not for developing countries. These issues are very relevant for our G20 meeting, and I have the pleasure to co-chair the International Financial Architecture Working Group with my Korean colleague Ji-Sung, and very quickly Ji-Young. And so in this working group, we are used to discuss about debt, restructuring, but not only, also the global debt landscape, and to try to help to build new initiatives to tackle debt vulnerabilities, like the debt service suspension initiative, or the common framework for debt treatment, where we have implemented debt restructuring together with China, with India, and all the Paris Club creditors, and I co-chair the Paris Club. So we have this topic about debt, and we also discuss about capital flows in this working group. From a structural point of view, we look at bottlenecks, general bottlenecks regarding the inflows towards emerging and developing economies, and also the management of capital flows, looking at what are the advices of the IMF, what is the code, OECD code, and how it is done in parallel. What we have also to look at is the evolution of the global debt landscape, and notably the fact that we have new actors active to provide sovereign loans to different countries. So in the past, the Paris Club creditors were dominant, and now we have much more, a larger diversity of creditors. China, of course, India, Saudi Arabia. The first creditor committee for Chad was co-chaired with Saudi Arabia, and then the other creditors committee with China. We have also the bondholders, we have the commercial banks, and so it's important to understand how these different actors they interact, and what are the choices for the different countries, and it is very linked with the possibility or not to borrow. And at the core also of the G20 work is the catalytic role of IMF and World Bank and the other MDBs. So as you see, we have here different speakers who can touch upon all these elements. I think that it will be presented what are the statistics regarding the debt distress, debt service, liquidity issue, just to flag that this point about liquidity has been highlighted by many different stakeholders in the last months, and it's a topic we will discuss at the end of the week. Do we need or not a comprehensive package, a new comprehensive package to tackle liquidity issues? We have also the classic discussion about volatility, uncertainty regarding monetary policies and the impact on capital flows. So we have here the great speakers to touch upon all these topics. We will start with Ayan Koze. So you are Deputy Chief Economist at the World Bank. You have also an experience at the IMF. You have also a large academic background, and you published a lot of important papers. And so I invite you to make your presentation regarding debt challenges. Thank you very much.
So, good morning, and let me thank the Bank of Korea, Minister of Finance, KDI, and Mark Uzan for inviting me to talk about debt challenges as we start, seeing the easing cycle of monetary policy beginning. So we had this very synchronized tightening cycle. We will now have probably the most synchronized easing cycle we have seen. What I would like to do, focus on very quickly 3 questions. The first one, what are the near-term prospects for economic growth, inflation, and interest rates? Of course, the answer to this question nowadays depends on the day of the week, given financial markets became very sensitive to high-frequency data releases, as we saw yesterday what happened in the US. Then I'm going to talk a little bit about this issue of the magnitude of debt challenge in the context of this question. What is the status of the 4th wave of debt? I will explain what that 4th wave. And finally, I will talk about the policy priorities. Hopefully, some of these things will align with what William talked about, what the IFI is trying to do in the context of G20. Most of my presentation will focus on emerging market developing economies, EMDEs. So, with the growth, I think it's fair to say that soft landing for the global economy is still the baseline. That has not changed. Growth is stabilizing around 2.6%. This is like the market exchange rate weighted growth rate for the global economy. For advanced economies, around 1.5%. For emerging developing economies, around 4%. This year's growth numbers pretty much settled. We are in September. Next year, there will be a little bit of a slowdown. In all likelihood, we will see. These numbers will be updated very soon, what you see on the screen. But not much. But there is quite a bit of anxiety about the strength of the US labor markets. We will need to see how things will play out in the coming months. The big challenge here, as much as growth is stabilizing at a weak level. So what does that mean? Prior to the pandemic, on average in the decade, we had growth around 3% at the global level. That's declined to 2.5%. In all likelihood, will continue. For advanced economies, growth was around 2% on average prior to the pandemic. It's going to be around 1.5%. For emerging developing economies, growth was around 5%. Going forward, it will be around 4%. So that's the first observation. Now, the second observation, the inflation and interest rates. We think that the disinflation process will continue. This year, at the global level, the inflation will settle around 3.5%. Next year will be a little bit below 3%. When you think about the global economy as a whole, inflation should average around 2.5%. For most countries, hit the inflation target. Eventually, we think inflation will settle a little bit above that 2.5% and a little bit above what we saw on average prior to the pandemic. Now, what about interest rates? This is important. The figure on the right is critical. These are market expectations for 2025-26 for the Fed, ECB, and the Bank of England. So the market is expecting, this is like a week before, interest rates settle around 3%, global interest rates. This will be much higher than what we saw prior to the pandemic. The average was around 0.5%, and will be much higher than the average of the previous 2 decades. So when you think about the real rates will settle around 1.5%, which is going to be much higher than, of course, what we saw prior to the pandemic, which was negative. So what is the answer to the first question? In the near term, growth will be steady, but weaker than what we saw. Inflation and interest rates, they are going to be lower, but they will remain higher than what we saw before the pandemic. So let me turn to the debt challenge. So when you think about the global economy, at least in the modern era, there are 4 major waves of debt accumulation. We have this study on global waves of debt, publicly available. So what you saw is that these waves are quite familiar with the audience here. From 70 to 89, you had crisis, major debt accumulation. 90 to 2001, a number of countries liberalize, and then of course you have problems in those countries, in other countries, Asian financial crisis. And then you come to basically 2002, 2009, that ends with the global financial crisis. And then we have this 2010 to present. This is the 4th wave of debt accumulation. Now we have debt at the global level around 250% at the global level, 275% for advanced economies, and a little bit above 200% for emerging developing economies. So what is this 4th wave in terms of its differences from the previous waves? This is another very important figure. For advanced economies, the debt continued to increase, but at a pace much lower in this 4th wave. For emerging market developing economies, if you include China, debt accumulation really was much faster. You see around 7 percentage points per year relative to GDP that went up since 2010. But even if you exclude China, this 4th wave was the fastest, largest, and most synchronized debt wave we have seen in the global economy. So what happened at the end of this 4th wave, we have now a number of countries with very serious debt distress. Where is that debt distress? Especially in low-income countries. So in 2012, we had 75% of them in debt distress. Now we have every single emerging market economy in debt distress, high risk of debt distress, or moderate risk. We have no low-income country with low risk of debt distress. In 2012, we have 50% of emerging developing economies. They had some kind of debt distress. That number went up to 75% in 2024. So this debt accumulation manifested itself in these debt distress, basically, indicators. And for lower income countries, it took a very heavy toll. It basically pushed all of them into one form or another experiencing debt distress or risk of debt distress. Now, a group that accounts for 40% of emerging developing economies. These are the most vulnerable developing economies. They basically have been going through this silent debt crisis over the past 3 years. Masoud alluded to this issue in his speech. So in these countries, we saw sovereign spreads basically picking up dramatically. You see on the left, for countries with relatively good ratings, spreads actually did not move, while interest rates went up significantly. For 1 out of 5 emerging developing economies, spreads went up above 10 percentage points. So the borrowing became prohibitively expensive. So what was the consequence of that? You see it on the right. There are now a very large number of countries with weak credit ratings. They are unable to issue bonds. So for them, market access pretty much disappeared. When was the last time we had this? Around global financial crisis. These countries have very large foreign currency debt. Because of this debt burden, their growth basically stunted since the pandemic. And most of them couldn't go back to pre-pandemic per capita income levels. So what is the answer, the status of the fourth wave of debt? The increase in debt was something we have never seen in the modern era, in this last wave since 2010. Of course, it has recently been accompanied by a rise in borrowing cost and much larger debt service burden. We did not hear much about a big emerging market debt problem, but there were many developing economies, especially lower income countries, really going through a silent debt crisis. Those are the countries, basically, they need definite help. Whether that is liquidity help or solvency help depends on the case. So let me turn to the third question. What are the fiscal policy priorities? So far, what I have said is the following. Growth is going to be weaker in the coming years. Debt will remain much higher than what it used to be, and the real rates is going to be positive and high relative to negative and very low, what we had prior to the pandemic. And this basically is a very explosive combination against the background of a very serious financing problem in these lower income developing economies. And there you have around 75 of them. In the World Bank, these countries are members of IDA, International Development Association. What you see on the left, grants to these countries stagnated. In level terms, actually declined by about 30% over the past decade. That pushed an organization like IDA to increase its grants, but that's, of course, small relative to their needs. And these needs are very large. Again, Masoud alluded to this issue when it comes to investment, when it comes to climate challenges. So, on the one hand, you have a very difficult debt challenge. On the other hand, you have very large financing gaps, and increasingly, global communities has the basically reluctance to provide the type of financing that's needed. Obviously, we have the IDA replenishment campaign this year. We are expecting all G20 members and the broader members of the global community to be very generous to address some of these problems. So what about the priorities? This is a very busy slide, but it has one message. The debt challenges faced by these countries do not have a magic solution. There is no silver bullet to address this problem. What these challenges will require, first, by the global community to acknowledge the problem and acknowledge that this is a very widespread problem. Second, acknowledge the problem has been taking a very heavy toll on development. We think that there is a very serious reversal in terms of development progress in these IDA countries, for example. And third, to basically implement practical, but at the same time ambitious solutions. At the global level, those solutions will require, in some cases, debt restructuring, in some cases, very serious relief. There are some cases that will require liquidity support, but in a number of cases, we need to be very ambitious in terms of addressing the stock problem, as well as thinking about how we can address the flow problem. In many countries, we have no option but to be much more aggressive when it comes to grants and concessional financing if we want these countries to make progress in the context of climate as well as other development goals. Is there appetite to do these things? It has to be seen, and I'm hoping that this IFI meeting will be instrumental to address some of those. In addition, of course, we have to do things at the national level. More prudent borrowing is important, and on the revenue side, we need to have more ambitious reforms. But we need to be gentle when we think about these. Let me quickly summarize. I asked 3 questions. The near-term prospects for activity, inflation, and interest rates. Their story, I think, is very clear. And the big challenge is to understand the magnitude of these terminal interest rates, but in all likelihood, we will see much higher interest rates than what we saw in the recent past prior to the pandemic. The second question is, how large is this debt problem? This debt problem is something we have actually never seen in the modern era in terms of magnitude, in terms of how fast we accumulated debt. And the third, in terms of policy priorities, especially in the context of these lower income developing countries, there are around 75 of them, global action is the key. Let me invite all of you to look at the webpage of the Prospects Group. We have a number of studies looking at these issues, and let me stop here. Thank you.
Thank you very much, Mr. Kose. I think you have perfectly set the scene regarding the quite challenging context emerging and developing economies are facing, and notably those with difficulties to have access to liquidity. On top of those which need debt restructuring. On debt restructuring, I think we have in place a framework. Of course, the implementation is sometimes challenging, but I think we have made progress. But on the other part of the actions, a lot of things remain to be done, and notably how to incentivize in a way or another private investors to come when there is a need of liquidity. What are the incentives? How to avoid to make them too costly for the public, for the governments? It's key questions we will discuss. I propose to move to the second speaker. Thank you very much. It's Laura Alfaro, Professor Laura Alfaro. You work at Harvard Business School, and you were a minister in Costa Rica in charge of national planning and economic policy. So it's a great pleasure to have you here to talk about uncertainty of monetary policy and financial stability. Thank you very much. The floor is yours.
Thank you very much. Let me start by thanking the organizers. This is my first time in Korea. I have had an amazing time. I have eaten more than I should, but your food is delicious and you keep us well fed. Second, being from Costa Rica, not a G20 country, but hopeful that one day we may have a G135 so that we can represent ourselves. I have always seen myself as representing the small open economies, but also growing up in Costa Rica a long time ago, I experienced the optimism of the 90s. And I think this was a time where we all saw the hope of globalization, where one firm would go to one country, source materials, hire labor, export to another one, and in the process bring efficiency, growth, and development. And as Eihan said, we did have crisis and higher interest rates, but still the environment was very conducive, in particular for countries that tried to do the right thing, and I think also Korea is an example. Again, there was a crisis, but the country managed not only to grow, but also to develop. Fast forward, we go to the current era where climate change, terrorist attacks, COVID, national security, there are all these concerns that perhaps globalization is creating risks for countries and firms, and now this new view that perhaps we need to favor reshoring and nearshoring to lower the risks. So I'm going to concentrate my comments in three broad topics. One, I think as emerging markets, perhaps we should congratulate ourselves. As Ahan noted, we have less crisis. So I think we have learned some lessons from the past. We have a little bit more resilient. And I stress most because there's a lot of heterogeneity in emerging markets. I'm from Costa Rica, my husband is from Brazil. We couldn't be more different. This is Latin America. There is also Argentina. I am sorry, I know there's someone from Argentina that is now trying to learn some of the lessons that perhaps some other countries have learned in the past, but there's also East Asia. Again, many countries have developed, so there's a lot of heterogeneity. But second, I also want to discuss this great reallocation where capital flows are reallocating on the back of this reallocation of global climate, of global value chains. And here I want to make the stress that there are many ways in which countries can cater a market. It could be trade, or it could be FDI, which is a form of capital flows. And I will argue that this form will continue to be relevant because in many ways the narrative that has pushed or attracted FDI to many countries will continue to be relevant, in particular because of jobs and incentives. But I will argue it will be harder to measure. And in the same spirit as the previous presentation, I will argue that sadly we will have limited space, one due to the backlash, in particular in rich countries against globalization, and the loss of an anchor, which will create uncertainty, but also there's path dependence. There are things we did to deal with COVID that perhaps, as they say in the US, the chickens are coming to roost or something like that. We have one in Spanish. I will spare you the one in Spanish. But this may also create some more limited space, especially in fiscal policies, and also perhaps more uncertainty. So let me start with some graphs that I took from the IMF that has made this point. Again, in general, there has been resilience in emerging markets. And again, we need to be careful because there's a lot of heterogeneity. But at least in terms of capital flows for the most part have come back, except in China being one of the big emerging markets. On your right, I have a graph that uses a Financial Times Greenfield investment, a proxy of capital flows. And here, the objective of this figure, just to show you that some of this trend actually precedes COVID and also some of the tariff policy. There was, in general, firms were rethinking the China market, and thus there was relatively less FDI in the form of greenfield. But again, there's heterogeneity, and for the most part, capital flows have come back in emerging markets. I would also, and I tend always to say this whenever I go to a presentation, I think emerging markets, we did a great job. Again, there's heterogeneity in dealing with inflation. Many emerging markets, especially in Latin America, were the first ones that increased interest rates to tackle inflation for many reasons. In Latin America, we are aware that inflation is a tax that is disproportionately paid by the poor, but also it destroys your middle class. And because of this, there was a first move, and thus also the first countries to bring down inflation. Again, there's heterogeneity. Korea has finally hit the target and is well in the target. Some Latin countries are not doing as well. Again, it has to do a little bit on political economy, but again, first movers in terms of trying to fight inflation and succeeding in fighting inflation. And behind this has been also better frameworks, resilience that have been built over the crisis. Many emerging markets learned the consequences of crisis in the 80s and the 90s and improved, in particular, exchange rate frameworks, making them more flexible and thus gaining more resilience. And I'll come back a little bit to this. But also behind a lot of the recent economic activity It's a comment that was mentioned yesterday by Caroline, by Daria, by Rolf. We are seeing this great reallocation of global value chains. In the graph here, I show 2017-22 and add the data from 2023. This reallocation is away from China that up to 22 was close to 5 percentage points, and now it's close to 7-8 percentage points, give and take. And the big winners are what I call high-income Asia. It would be Taiwan, Korea, Singapore, middle-income Asia, and different countries, India, Thailand, but also a lower, again, middle-income like Vietnam, but also, and I have always been amazed by this, NAFTA countries. I don't like the new term, Izumska, fair enough. In particular, Mexico. And I have always been surprised about this because Mexico already had a very deep relation with the US and has managed to even grow more this trade relation to the point that it's now the main trading partner in the US. And let me remind you that the new trade agreement has a clause to revisit the trade agreement in 2 years, and this is going to create a lot of uncertainty, and I think it's not in the radar of many participants. But we have seen this great growth and reallocation of trade, and behind this reallocation, we have seen also this reallocation of capital flows, in particular FDI. And here, as I said, one needs to be careful to try to infer too much if we see a reduction in trade, just to assume that there is less globalization, because firms can cater a market through trade or through FDI. Depending on the conditions, they can be complement and substitutes, but again, be part of a more complex globalization process. And FDI has always been the way in which firms have navigated restrictions, tariffs, and protectionism. This was the case in Japan in the 80s and 90s, where the US started to limit the car industry going to the US. So what the Japan did, started to open plants in the US. So auto plants are open in the US. This is also the case in Korea, where they start going to other countries, not only to deal with the higher protection, but also related to increasing costs in the country. So this is a form that firms can use to deal with these trade barriers. And I will argue it will remain very vibrant, because FDI is the special form of capital that has technology, management skills, know-how, and this bundle has a lot of attractions for countries because it has the potential to create spillovers, linkages, jumpstart development, but for politicians, it's a quick way to get jobs, and so they tend to offer a lot of fiscal incentives. In the US, this is happening, and thus it will continue to remain a vibrant form of capital flow. And this will come with some measurement issues. It will be harder to measure capital flows in many ways. One is just associated with the complexity of economic activity. It is just harder to measure FDI when it's associated with R&D and IP, think patents, knowledge, relative to when it was manufacturing. And so it's just going to be more complex because life has become more complex. In most countries, services dominate economic activity. There will be also issues of control and ownership, where it's located, what is the percentage of ownership, it is public, government, if it's a merger and acquisition, an SPV, is it Vanguard owning a lot of these foreign companies? It's just going to be harder to measure. There's going to be also the complexity of globalization. We put one little part in one country and another part in another. This always has issues of measuring. The role of sovereigns, is it a government or a quasi-government agency? New forms of capital flows, crypto might be financing FDI. And finally, the way we just measure. There was a change in the way we measure FDI. I don't want to bore you with a lot of details, but it used to be more directional, and the new change is more assets and liabilities, and so it's perhaps better for macro analysis, but it's not as good as before in trying to know where FDI was going. And again, in general, the issue of related party trade. makes this more complex. So we're going to have more, but it's going to be more difficult to measure. This is, for example, the case in Mexico. There is no doubt there's a reallocation. You cannot see it in the FDI data because, again, the way it's measured means it is not there. We need to wait until it actually happens, and what is the percentage that is going to be owned by foreigners relative to how much is financed by domestic banks, for example. But beyond the issues of measurement, again, it will be very hard to China to replicate what Japan did in the 80s and 90s in the US, but they're increasingly trying to replicate it elsewhere. And so even in Mexico, that was a country that was dominated by US foreign direct investment. If you look at growth rates in cars and auto parts, 75% is now coming from China. And this off the back door that was also mentioned yesterday, it's just happening. China's trying to find ways to cater the US either through imports through third countries or through FDI in third countries. And again, this just means that it's still the case that we may be connected when buying a good in the US to a Chinese firm, but it's going to be more complex. I actually do think that through FDI it mitigates some of the political concerns. After all, if they're going to invest in Mexico, there is the trade agreement that deals with it a little bit with value added, but also if China becomes complicated in Mexico, it has to fire Mexican workers. And so it first has to deal with the Mexican authorities before having to deal with the US. So actually, I do think it mitigates a little bit the concerns, but it's not necessarily an end to all uncertainty. Let me go back a little bit to resilience and fundamentals. It is actually very surprising that this reallocation happens so quickly. I know we tend to think about Apple that has like 900 suppliers, but the medium firm tends to have only one supplier abroad. And so this change, which Caroline mentions, is called the China Plus One, actually happened very quickly, and it's very interesting the process of how firms manage to reallocate. At least for the US, in work that I'm doing with folks from the Atlanta Fed and the IMF, we have found that US banks played a key role in allowing firms to reallocate. And I want to stress this because this was a time where the US banks were very well capitalized. And this allowed them to help firms, in particular firms for which they had relations, to tap their network, or in particular in Asian countries. So again, the resilience of the financial system is also something that emerging markets we have learned, and indeed we have improved the resilience of capital, of the financial system, and this is key for the resilience of capital flows. And as I said, for the most part, many emerging markets have also worked on this. Let me just finish on a more negative note, if you want, against my Latinness optimism. One is that reallocation is costly. It was mentioned yesterday. We do document that goods that are now being brought even from Mexico or Vietnam that used to be brought from China are 10% more expensive. So this reallocation is costly. This reallocation is also at the back of a backlash in the US against globalization. With our co-authors, David and Maggie, we have been conducting these surveys in the US on national representative samples. We have documented that the US, which used to be a country that favors trade, is now in general against trade. Our randomized experiments that have provided information against the benefits of trade, either in jobs, in prices, or the negative effects of tariffs, find that people cannot distinguish anything about trade, good or bad, and concerns about jobs and China. And thus, this backlash of globalization in the US that had led to industrial policy, more tariffs, and again, it is compatible for more capital flows, but again, it does make you wonder what's going to happen in terms of policy going forward. And for me, the biggest concern was that the US used to be the anchor of the system. Again, it is not the case that they had no intervention, but for the most part, it had a philosophy of globalization, and we have lost that anchor. And as again, people are revisiting the Bretton system and the international financial system, I think this loss of anchor is going to be a concern, and thus we have more trade wars, more tariffs, more backdoors, and we just see every country out there offering and more tariffs, more policies, and again, countries trying to find a way around it. And just to finish, there's the concern of the growth. Again, the US has been growing on steroids. What will happen if it just doesn't grow as much, even at 1% less? But also the concern on China. China was the reason why many developing countries were growing, in particular commodity-led boom. China's not going to grow as much. This is on the back of the US spending like crazy. Every time I open the US newspaper, all the politicians have become now in a contest, who can outdo Argentina in terms of populism? They're offering more spending, less taxes. Again, it's just all over. It was mentioned yesterday, there doesn't seem to be any attempt to consolidate in the US. And sadly, emerging markets also, we have less space in terms of what we can do because of all the policies that we have implemented in the last 5 years. Let me end that. Thanks.
Thank you very much, Laura Alfaro. You have raised many questions, I think, but it also relates well with the discussion we had yesterday. And I take the opportunity of being a moderator just to flag something which strikes me yesterday and also in your presentation, which is this reallocation. Of course, there are some resilience reasons, justification behind that, but there is also another dimension which is present in the US, in Europe. It is a question of fair competition, the relation between excess capacity and implicit or explicit subsidies. And I think that we need to have input from independent experts in order to document what has a real impact, what is perhaps exaggerated, I don't know, because there is also this dimension which can explain also some measures taken in Europe and in the US. I propose now to move to the three discussants. We will start with Miru Kim. So Miru Kim, you are head of the government bond research at the Korean Development Institute. Thank you very much.
Okay, so hello everyone. I'm Miru Kim from KDI. First of all, I'm very happy to be a discussant on Global Economy and Financial Stability Conference. And especially, I'm very proud to be a discussant of Ayan Kose's presentation, whom I always admired. Today, Ayan Kose provided a very clear and comprehensive explanation of the trends and characteristics of the global debt cycle over the past half century. He also highlighted the most important aspects of the fourth wave of debt, which is the most important to us since we are currently facing. So let me briefly summarize the fourth wave of debt from today's discussion. The fourth global debt cycle is different in a few key ways. First, it's grown the fastest and the largest compared to any previous cycle, especially with private debts increasing rapidly. Second, unlike the last three cases, this time the money is flowing into emerging markets instead of advanced economies, and this is true even if you exclude China. Lastly, since 2022, policy rates have been hiked quickly to tackle global high inflation, but the impact of the interest rate hike has been very different across emerging markets. So today I'd like to focus more on the first and second characteristics of the fourth global debt cycle. As I listened to this presentation, what stood out to me the most was the question of why we are once again facing global debt expansion, which is the largest and the fastest growing, despite the fact that all three previous debt expansions ended in tragic financial crisis. Simply put, after experiencing several crises, why do lenders keep lending? That's what I want to talk about. Debt always involves both a borrower and a lender. While it's a liability for a borrower, but it's an asset for the lender. Whenever I look at the increase in debt, I always try to think the corresponding increase in asset on the other side. And while debt has been growing, real interest rate, which represent the borrowing cost of debt, have been trending downward since the early 2000s, aside from the last 2 years. The decline in real interest rate indicates that the marginal productivity of capital has been gradually decreasing, and this suggests that capital stock has been growing faster than productivity, which means the supply of capital has expanded more rapidly than the demand for capital by firms. In that sense, to understand why global debt continues to grow while the cost of funding the debt keeps falling, it is important to take a look at both the supply and demand side of capital. And in this slide, the figure on the left-hand side shows the relationship between households' accumulation of financial assets and life expectancy. And the figure on the right-hand side illustrates the relationship between household accumulation of financial assets and the expected remaining lifespan. Although it's not a perfect comparison, since it's a cross-sectional analysis between countries at a single point in time, there is a relatively clear trend showing that household accumulation of financial assets tend to increase as life expectancy rises and as the expected remaining lifespan lengthens. As you know, the main reason that households accumulate assets is to maintain a certain level of consumption even when their income decreases in the future. Therefore, if life expectancy continues to increase while the period during which people can participate in the labor market remains fixed, households will want to save a larger portion of their current income as their post-retirement years lengthen. This can lead to a structural slowdown in domestic consumption and result in a structural increase in current account surplus and causing households to accumulate more assets than before. Finally, the increase in asset accumulation leading to an expansion in capital supply creates a more favorable environment for borrowing money, also with low real interest rate. I'm not saying that the increase in life expectancy explains everything, but the rapid rise in life expectancy and the accelerated aging of population worldwide since 2000 can largely account for why the fourth debt cycle has unfolded on a much larger scale and at a faster pace compared to the previous three debt cycles. Also, the fact that the increasing speed of life expectancy and population aging varies among countries, this may explain why much capital has flowed into emerging markets. This chart shows the IMF's estimate of how changes in demographic structure impact both current and future current account of each country. For example, increasing life expectancy tends to boost the current account of advanced economies in the late stage of demographic transition. On the other hand, it reduces the current account of emerging economies. This implies that countries in the later stage of demographic transition tend to experience capital outflows due to the overall effect of aging, whereas countries in the early stage of transition tend to attract capital inflows. Of course, beyond the demographics, the fact that advanced economies have experienced more severe declines in productivity than emerging markets has reduced the need for capital borrowing in advanced economies while increasing it in emerging markets. However, the rapid aging of the population, which has continued to be centered in advanced economies, appear to be an important factor driving changes in international capital flows. South Korea is no exception. Life expectancy in Korea is increasing at nearly twice the rate of OECD average, and rapid aging is occurring due to persistently low birth rates. This has led to a structural decline in domestic consumption, resulting in a current account surplus and a steady increase in net foreign assets. The discussion so far suggests that the increase in life expectancy since the 2000s and the relatively faster aging of populations in advanced countries can help explain why the fourth debt cycle has been the largest and fastest compared to the previous three cycles, and why there has been a significant inflow of capital into emerging markets. Additionally, it is well known that rising inequality can have similar effects, owing to by Professor Atif Mian and Supi. Of course, these discussions don't mean that there's no need for concern. If emerging markets fail to repay their debts, those who landed the capital could face losses on the assets they accumulated for retirement. Moreover, if trust is lost in financial markets, it can take a long time to rebuild, potentially leading to prolonged and serious losses in overall macroeconomic inefficiency. However, what I want to emphasize is that the increase in total debt can be driven by fundamental macro factors such as rising life expectancy, population aging, and growing inequality. Therefore, rather than worrying about the scale of debt expansion itself, the focus should be on whether capital is flowing into borrowers who can repay it. This means that it is crucial to monitor whether the capital raised by debt is being used productively in order to maintain financial soundness. Finally, I believe that the policy implications suggested by Ayan Kose are very important, especially delivering technical assistance to facilitate improvements in emerging market, fiscal, financial, and debt management frameworks is crucial. Implementing fiscal rules and establishing fiscal councils that ensure long-term debt sustainability and transparency are also essential steps. Only when these conditions are met can emerging market local currencies gain trust, allowing them to issue local currency bond in the future. And as a result, this would help lessen exposure to currency risk and rollover risk. Hopefully, the fourth debt cycle will not escalate into a major crisis like the previous three tragic endings, but instead conclude happily for everyone. Thank you very much.
Thank you very much, Miru Kim. We move to Lena Mosley, a professor at the Princeton University. You have done a lot of passionate work regarding notably the link between domestic policies and the behavior of international investors, and we look forward to your insight. Thank you.
Great, thank you. So I want to sort of start where Dr. Jose left off, because he gives us a great summary of the fourth wave of debt in terms of thinking about the diversity of creditors and thinking as well about the diversity of debtors. That is to say that there are some very strong emerging market and developed economies, and there are some that are in weak positions. He ends his presentation with a summary of fiscal policy priorities, thinking both globally and nationally. At the global level, things like debt relief and more concessional financing. And at the national level, thinking about broadening the revenue base, prioritizing public spending that contributes to long-term growth. And where I want to start is to say that the capacity to achieve these sorts of aims depends on politics, international and domestic. And so I really appreciate that the organizers have this session on debt, and that we can sort of then start to think a bit about the political economy considerations that relate to debt. So if we think about eliminating fossil fuel subsidies, for instance, this is a very contentious issue in domestic politics for both producers and consumers. If we think about relying on taxation as opposed to debt, then we have to think about who's going to bear the burden of that taxation. And this gets as well to something that Laura Alfaro mentioned in terms of the backlash against trade as well as intergovernmental organizations in wealthy democracies. And so I think it's useful, especially now on the 80th anniversary of the Bretton Woods institutions, to keep in mind that geopolitics and strategic interest have long mattered. Right? And there's a lot of focus now on so-called geoeconomics. And to those in economics who are now studying the importance of politics, I just want to say welcome. The political scientists have also been thinking about this for quite some time. We've thought a lot about how the creation and the design of intergovernmental institutions, whether it's the World Trade Organization or the IMF, reflects the influence of powerful states. We can think about how the rise of new creditors and the presence of new financing instruments for sovereign borrowers creates opportunities for borrowers. But this also then sort of can disrupt the old system. So for instance, we could think about how the Asian Infrastructure and Investment Bank might be a complement to and work with the World Bank, but might also be a competitor to the Bretton Woods institutions. We also know, and I say this in front of William, knowing that he knows very well, better than I, that the presence of new creditors also makes more difficult the functioning of the Paris Club when it comes to dealing with debt restructuring. So kind of more generally, we can think about being at a point of power transitions. And when we get those kinds of power transitions, we know that the functioning of international financial institutions faces important challenges. So if we think more generally about the role of politics, geopolitics as well as domestic politics in sovereign finance, and we go to the area of multilateral lending, right, we have a long literature which suggests that one of the things that matters, certainly not the only thing, but something that matters, all else equal, and in particular cases, to how the IFIs behave are sort of the interest, whether it's commercial or strategic, of powerful member countries. So there's a great deal of research on this in political science and political economy, thinking about how things like loan sizes, the number of conditions, the enforcement of conditions, the recommendations in debt sustainability analyses, all reflect considerations, either sort of direct weight on the scale by large member states or the staff kind of anticipating those kinds of concerns and altering their behavior. There's also evidence that when it comes to bilateral, that is government-to-government lending, and this also holds up in the case of foreign aid, that lenders and grantors have hard and soft power objectives when they give loans and when they give aid. Now, this isn't to say that it's the only part of what matters, right? That's the supply side. We also know on the demand side that borrowing governments have preferences over creditors. So for instance, my co-authors and I have work in which we find that government's propensity for transparency of economic policy inclines them to borrow from certain kinds of creditors versus others, right? The governments that want to be opaque might borrow in certain ways and from certain creditors compared to those that tend to be more transparent. And we also know that geopolitics and that creditor governments matter for how private sector actors evaluate risk. So there's some recent work by Lauren Ferry and Patrick Shea in political science that finds that states that have closer ties to the US restructure at higher rates than those without close ties, and they receive less punishment in the private markets, perhaps reflecting an anticipation of assistance or bailouts at higher levels to countries that are close to the US. So just to give a little bit of descriptive data on this, these next two charts use a measure of geopolitical alignment between countries. This is based on key votes in the UN General Assembly, which is used to calculate countries' ideal points. And so here I'm using 2017 for the light-colored dots on either side and 2022 for the darker dots. And this first one is looking at a set of countries that are deemed to be in or at risk of debt distress. On the red dots indicate the size of their debts to China, and the blue the size of their bilateral debts to the US. And then we can sort of look a little bit at movement over time in their ideal point distance. What we see, though, is that many of the countries facing debt distress tend to be geopolitically closer to China. They also have high levels of debt to China, perhaps not unrelated. And this may complicate the functioning of traditional mechanisms for dealing with debt relief and debt restructuring. I won't go into it a lot here, but this looks instead not at ideal point distance, but at exports to the US in the blue and to China in the red. And so these kind of geopolitical and commercial relationships with important countries are probably going to matter for the ways in which debt crises get resolved. Now, these geopolitics are not the only kind of politics that matter. They interact with politics within countries. And this is true in both creditor countries as well as in borrowing countries. Governments care about staying in office, whether that is through the ballot box in democracies or through other means in less democratic and more autocratic countries. So creditor governments care about their political survival. They're going to think about the exposure of their domestic financial institutions to debt crises. We might think about how mass publics have attitudes toward foreign aid as well as concessional finance, and this might matter for what governments do in the restructuring as well as in the grant-making space. We also could think about something like export finance, reflecting not only sort of government strategic interest, but the interest of firms inside those countries who stand to benefit from export credits and export lending. And if we think about the particular case of China, we could think about how policy bank staff probably have career incentives to avoid restructuring, right? And this might help us to understand the position China has taken with regard to debt restructuring in places like Zambia. Okay, so the last place I want to end then is thinking really about domestic politics in borrowing countries. And those of us who study debt spend a lot of time thinking about countries that get themselves into crisis or are at a current high risk of debt distress. And that's important, of course, and those crises can threaten global financial stability. But to understand why countries eventually get themselves into crisis, we need to think more about the entire life cycle of government debt. Right? We want to think about what explains why governments borrow in the first place, from which kinds of creditors they borrow, with what kinds of instruments they borrow. And this is partly as well a function of domestic politics. Right, so I mentioned this first finding about government's propensity for transparency or opacity helps explain the composition of their borrowing, that is to say, the choice of their creditors. We know as well that when investors are thinking about pricing sovereign default risk, many things matter, including government ideology, that is left or right, the electoral cycle, and the sort of broader political institutional environment. There's a long literature suggesting that democracies are better able to borrow than their non-democratic counterparts, although some of my more recent work on that suggests that that's conditional on the global capital flow cycle, that those institutional differences really matter when markets are tight versus when they're liquid. And then, of course, we can think about when governments decide whether to service their debt or not. That's going to depend, of course, on who bears the cost of austerity, who bears the cost of repayment, and who your creditors are. Again, are they domestic, are they foreign, and who specifically are they within those buckets? And that finally is going to get us to questions about when debtors and creditors are able to agree on restructuring. So the take home here is that we can really think about sovereign debt as a question of economics as well as politics, and those politics are global as well as domestic. Thank you.
Thank you very much, Elaine Mosley. A lot of questions, and I hope that academics like you will look at what we are currently doing for Zambia, Ghana, and currently Ethiopia, and I'm sure that this type of analysis could be very helpful. And we just to flag that we have created something new. between China, India, Saudi Arabia on one side and Paris Club creditors. There is something new, and I hope it is something useful for the borrowing countries, but I'm a bit biased, and so we need independent analysis to look at that. We move to the last discussant, Jae-Woo Lee, Assistant Director at the International Monetary Fund at the Research Department. Thank you.
Let me first thank the host for organizing this excellent conference and giving me the opportunity to participate. And as you see, I also have to state this disclaimer. This is me, not the IMF in any way, except in the affiliation, in the job affiliation. In case Laura feels lonely, I'm designated discussant of your presentation, so that's what I'll try to do. I'd like to share several thoughts on the theme of this session, monetary policy, capital flow uncertainty, relating to Laura's excellent presentation. So let me start with a point on capital flows, where Laura, to my great pleasure, featured a chart that has been produced by IMF team in our external sector report. So one of our readings of this chart was a reversal in capital flows in 2022 and 23, which brought back a so-called uphill capital flow in about a decade. It is not as stark when presented this way. It's largely because we are taking China out. But you can picture, if we had lumped it together with China, there is a reversal of capital flow. It's a capital outflow from emerging markets to advanced countries. A contributing factor to this reversal is none other than global monetary tightening, which happened in response to big jump in inflation, which arguably was a momentous global event in financial scenes during the past several years. It's not just about emerging markets. Even in advanced economy, there is a very clear case of the impact that this global monetary tightening had on an economy. It's none other than ups and downs of yen carry trade. It has been going on for several years and seems to have kind of ended or reversed itself this August with the surprising volatility associated with the unwinding of the yen carry trade, which entailed a very sharp yen appreciation as well as swings in asset prices and VIX, and this for a few days, maybe less than a week. So against this big global development, emerging markets, though, were relatively resilient, certainly more resilient than in the past. Again, a point noted by Laura in her presentation. There is a longer history of the impact of dollar movement, US monetary policy movement, and its effect on emerging markets under the name of global dollar cycle. The most prominent paper that was done on this topic is the piece by Maury Ofsfeld and his co-author about 2 years ago. But this time, despite the significant appreciation of US dollar, emerging markets fared pretty well. There are about 2 reasons I would like to share. One is the one relatively well-known. Emerging markets policy fundamentals have become stronger. I'd recommend a paper by Joshua Eisenman and his co-author, having tried to document it more systematically, not to mention that there were many other observers or commentators which made this point, including some of publications from the IMF itself. The other point that I want to bring your attention to, which is a bit less appreciated, is this reversal of correlation between oil price and US dollar. And this, for the past 20 years, the common sense wisdom has been that when dollar appreciates, oil price decline. 2002, 2003, it went the other way. Dollar appreciated and oil price increased. And that helped to soften the impact of dollar appreciation caused by US monetary tightening. on many emerging markets. So when we look at emerging markets as a whole, commodity exporters, oil exporters are a big part of it, and they didn't have to suffer as much as in the past, so that helped. A quick peek on that is this last chart on the right. The red line shows the correlation between US dollar and oil prices. If you focus on right half of the chart, which is from 2000 onwards, you see the correlation having been negative, except at the last phase, which is the past couple of years. And people have been often associating with the change in the US turning of the US from oil importer to exporter status, but that's not the whole story if you look at the earlier periods, because you would see correlation changing signs between positive and negative before pre-2000. Let me just stop at that, because my main duty is to discuss Laura's paper, not to advertise our work too much, although I tried a little bit. And also because I think it's a substantive issue. But anyway, this big movement and monetary policy and global interest rate is coming to an end with the signs of inflation stabilizing, although last mile has to be seen. But now the bigger brewing challenge is this force of tendency of fragmentation and the backlash to globalization. Okay. Laura's presentation made me to think of this, what's happening in 3 R's. First one, reshoring. Evidently, in the decline of China as the preferred destination of greenfield investment. We learned from Caroline yesterday that reshoring in the sense of return of investment is not quite happening, but as far as this trend continues, share of foreign production, and its production in China, will tend to decline. The other is rerouting. It's round-tripping, going through third countries, that well documented by Laura again. The last point is something I learned afresh from presentation. It's what I would call remolding. Foreign direct investment, we know that can serve a dual role, and it's a substitute for direct trade is likely to be increasing. I think it's a very interesting point. But where would this get us in terms of our fears about fragmentation? There can be 2 extreme possibilities. One is fragmentation to the level of near autarky, which we in the IMF have assumed in quite a few simulations. But it's a bit of a conceptual exercise. The reality is, I think, the world or the international commerce is too intertwined to be separated or severed neatly into neo-autarkic blocks. And I think we again had quite a few consistent evidence presented yesterday by Caroline and also by Disconson Eunhee that global value chains actually much densely woven than we tend to think from aggregate data, and also much more complex to undo. But if that is the case, then can we expect full commercial or economic rationality to prevail so that we can regard this political push as a bit of secondary influence, not necessarily a mere sideshow? For that, I think we also know that there is a limit to economic rationality to prevail. Laura gave a very nice evidence on the backlashes to globalization being tainted, there is a typo, being tainted by priors which are not necessarily economically based. And as far as that is the case, the reasonable conclusion that we can expect would be the future is uncertain. We do not know what will be exact political influences or security concerns that will be affecting economic logic of organizing international trade. Nor, in addition to that, nor are we sure, even if we fully have exact idea of what kind of political security influences will be impacting global trade, I do not think we have a clear idea what the exact economic consequences of those non-economic influences will be. The reason why I put up the Chatelier principle is that trying to think about it, I realized that the profession has not been thinking about this much to the point of causing me thinking of this principle that Paul Samuelson brought into economics. If you put restrictions on something, something else will happen. And in international finance, right, Don Bush's overshooting is one way to think of as an application of it. So given that uncertainty is, I think, the norm, under that situation, what do we do? There is a popular economic logic that when there is uncertainty, there is an option value of waiting, which indicates, proposes postponing the action. But there is a flip side of it. There is a cost of waiting. There are certain situations when taking a bit of preemptive, let's say, prudent, preventive action in advance brings about better outcome. I will return to the example of emerging market resilience as an indirect evidence of such preparatory action. Had the emerging markets not made an early investment in strengthening their policy fundamentals, they would have had much more difficult situation during this round of global monetary tightening. Given the time, let me just wrap up with just one remark. So what are the policies, advanced policy preparations that can be done? I would emphasize everything, right? Essentially, macro policy is inherently general equilibrium. Even though the theme of this session is monetary policy, to conduct a sound monetary policy, you need a reasonably sound foundations and environments in every major policy arena. So therefore, you cannot just single out one or two policies. In addition to that, given the global nature of the trade and financial flows, strengthening financial system in advanced economies can have a great benefit not only for themselves but also for emerging markets. Let me just stop at that, given that I'm taking up too much of the time, and thank you very much.
Thank you very much, Jeuli. Looking at the time, I'm afraid we don't have enough time for question. If you want to have a coffee break, unless there is one person with a very short remark, just if you want to have a few seconds to say something. Just looking at the room, if there is someone with a very specific point? No? Okay, so I propose to thank all the speakers and the discussants. I think that you have highlighted how important it is to analyze macroeconomic policies, spillovers, domestic policies, and also with the political economy point of view. I thank you very much, and it's time now for a coffee break. Thank you.
Thank you very much for the insightful discussion on the uncertainty of monetary policy and its impact on the global financial stability. Thank you very much, Mr. Chair, and the speakers and discussant. As we wrap up this session, let's take a break until 11:15. For those who haven't received a lunch coupon, please proceed to the registration desk and scan your name tag. And feel free to have snacks and coffees we have prepared in the lobby area, and we will reconvene at 11:15. Thank you, everyone. Ladies and gentlemen, we'll soon begin the next session. The distinguished guests who are standing in the lobby area, please kindly proceed to your seat. Once again, the 2024 Global Economy and Financial Stability Conference, the next session will begin. So please kindly take your seat and turn off your phones to the silent or vibration mode. Welcome back, everyone, and we're excited to continue with the fourth session, and we appreciate your energy and engagement as we move forward. In this session, we're going to talk about digital finance, AI, and financial stability. And allow me to introduce the chair for the fourth session, the Professor Chunil Kim, the visiting scholar of the Korea Development Institute. So ladies and gentlemen, please join me in welcoming our chair and speakers and discussants with a warm round of applause.
Thank you. Good morning, and thank you for coming to this session on digital finance, AI, and financial stability. And my name is Junil Kim, and I'm currently a visiting scholar at KDI and a visiting professor at Yonsei University. I'm very pleased today to be moderating this session, which is timely and interesting, but also kind of futuristic. As we know, we live in in a world today that is very different from 20 or even 10 years ago, due in no small part to the rapid growth of digitalization and technological innovation. The digital revolution, along with advancements in artificial intelligence, have had an impact on many sectors, including the financial sector, which has been transformed in many ways. To note a few, advances in digital payment systems have revolutionized the financial transactions. Private digital assets have grown remarkably in a short span of time and are exercising an increasing influence on capital markets nowadays. In response, central banks have been considering issuing their own digital currencies, known as the CBDCs, with a few countries have already taken the plunge. And artificial intelligence has had a notable impact on the financial sector, affecting both back-end and front-end operations. As the new kid on the block, so-called generative AI, has also been making inroads into the financial sector with the expectation that it will significantly affect the provision of the financial services by financial institutions going forward. Okay? As history has shown, technological innovation confers opportunities and benefits, but also carries different types of risk. For example, the risk associated with the decentralized finance, cyber threats, application of AI to trading strategies, and also risks to market integrity, consumer protection, and so on, which can all have serious consequences on financial stability. To help us better understand some of these opportunities and risks, we have a distinguished set of speakers and discussants with us in this session. Let me introduce them. Next to me, Dr. John Schindler, Secretary General at the Financial Stability Board in Basel. Before joining the FSB, John spent more than 20 years at the Federal Reserve Board, most recently as a Senior Associate Director in the FRB's Division of Financial Stability. In that role, he also served as the first chair of the FRB's Financial Stability Climate Committee. And next to the second speaker is Dr. Mabash Kresh. She must be on our screen. Yeah, thank you. She's an assistant director in the Monetary and Capital Markets Department at the IMF, who has joined us virtually today from Washington, D.C. She has published widely in top scholarly journals and is the author and editor of several books on capital flow and other macro-financial subjects. For discussants, first one is Xiaonan Zhou, the head of digital assets of UBS Group Treasury. She's an expert in digital assets and represents UBS in fintech, digital assets, and CBD's topics with the industry associations and public sector. And next to her is Sung-Wan Yoon, a director of Digital Currency Research Division at the Bank of Korea. He has a very diverse career at the Bank of Korea, working at the research department and international department, and offered his expertise to the BI's Committee on Payment and Market Infrastructures. Finally, Dr. Oliver Winch, partner in Oliver Wyman's Financial Service based in Zurich. Oliver has worked for more than 20 years at and with governments, central banks, supervisors, supranational institutions, including the IMF and BIS, as well as commercial banks, advising on various aspects of sovereign finance and financial stability issues. Okay, let me welcome and thank you all. So I'll now invite the two speakers to make their presentation for around 15 minutes, with John giving a broad overview of the future of the international financial architecture against the backdrop of technological innovation, and Mabash Kresh focusing on a key risk against this backdrop, which is becoming an existential threat for institutions, that of cyber risk. Okay? I will then ask three discussants to offer their remarks. So without further ado, let me give the floor to John Schindler.
Great.
Yep.
Thank you very much, Chair. And thank you to the organizers of this conference. I greatly appreciate the invitation to be here today. I really like the theme of this day, the evolution of the global financial environment and the new financial system, and you'll see that I have sort of tweaked that to talk about the future of the international financial architecture. It'll become clear in a moment why. I very much like these sessions where we're thinking about the future and we're looking ahead. The FSB, for those who don't know, was created about 15 years ago by the G20 and was charged with protecting the resilience of the financial system, which I view as an inherently forward-looking mandate that we have. We think about the vulnerabilities, we think about the potential shocks, we take actions now to make the financial system more resilient. One of the things we've been doing for a long time, for more than a decade, is thinking about financial innovation. In fact, we have a group that is dedicated solely to thinking about financial innovation, and they have one of our longest standing groups. So I will spend some time talking about two particular types of innovations today, and then I'm going to abuse my privilege of being up here to talk about a non-digital innovation for a little bit. I'm also going to be a little self-serving by using a paradigm that I used in a paper about 7 or 8 years ago. I did not put a link to the paper, so I'm a little bit less self-serving than I could be, but this is a way of thinking about financial innovation. So I want you to start by thinking about a building, and on the left-hand side there, you see a building that's pretty much completed. And when you look at a building that's just been completed, you probably know what it is. It's a hospital, or it's a high-rise hotel, or whatever it is. And as they put on different windows or doors or landscaping, nothing changes. It's not like you go, oh my goodness, now I see what it is. You know what it is. We can change features of buildings all the time. It doesn't change fundamentally the building, but it's a way of keeping things fresh and new. If you want to make real change, you have to tear down the building. So you start with the same foundation, you build something new on that foundation. So if you have an existing foundation, you could tear down the hospital and you could build a high-rise hotel. Okay? You can make more profound change by tearing it down and building something new. But if you want to make the most profound change, you tear down the building, you rip out the foundation, you can put in a new foundation. When you put in that new foundation, the possibilities are endless. When you put in a new foundation, I can't tell you what the future is going to be until I see you start building, okay? It's also pretty rare that we tear out the foundation. It's expensive, it's hard work, so it doesn't happen very often. So what does this have to do with financial innovation? If you think about something like a corporate bond, as soon as I say those words, you have an idea in your mind of what a corporate bond is. It's a debt obligation issued by a company where they borrow money for you in exchange for interest rate payments. Now I can make that callable or puttable or renewable or extendable. It's still a corporate bond. We all know what it is. The effects of that change are not very profound, but this is the type of financial innovation that happens all the time. If I want something more profound, something where I'm tearing out the superstructure, you could have something like a mortgage-backed security. It trades in the same way as a bond. It trades on the same types of platforms. But really, you've ripped up the bond structure and thrown it out and said, well, I'm going to gather a bunch of assets, and they each have their own income stream, and I'm going to package them together, and it's essentially going to pay out an interest rate, and I can structure that in various ways. So this is a more deep, it's a more profound innovation. That mortgage-backed security is really different from that corporate bond. And when I say mortgage-backed security, you probably think of a different idea. But it's built on the same foundation. Then if you really want to make profound change, you rip out the infrastructure. Okay? You rip out that foundation. Let's say I rip out that bond market platform on which these are all built, and I put something in place, like a distributed ledger. Now with this, I've ripped out the foundation, so the possibilities are endless. What am I going to build on top of this? Now I could build a bond market on top of it. I could trade bonds on a distributed ledger. I could trade the asset-backed securities. But maybe I can trade other securities as well. I can trade equities. I can put other things on top of this. It's very difficult to predict what the implications will be. And that's why we're talking about things like tokenization, artificial intelligence, and things like that today. Because we see these innovations. They're very rare, they're very deep or foundational, and so what the effects are over time are very difficult to predict. I'm going to spend time on just two of those today, tokenization and artificial intelligence. As soon as you say the words tokenization, my guess is the images that have popped into your mind, the ideas are very different. Whenever a member of the Financial Stability Board says they want to talk to me about tokenization, I first have to say, okay, stop. How are you defining it? Because there are so many different definitions of what it is right now. I'm going to use a very simple definition to think about it. So I'm going to talk about the process of representing assets in a digital nature on a distributed ledger. We can argue about this. Maybe you've got a different definition. Completely understand. You can represent assets that are pre-existing. You can put corporate bonds on a blockchain by tokenizing them. You could do this with equities. You could do this with bank deposits. A lot of talk about that right now. You could do this with instruments that are new. Bitcoin, Ether, Tether. These are all new assets that didn't exist before we had the distributed ledger technology. Okay? So what are we doing in this area? At the request of the G20, we are a G20 organization, the Financial Stability Board is writing a report right now on the financial stability implications of tokenization. This report will be delivered to the G20 next month, so I'm going to give you a little tease, a little preview without telling you actually all the results that we're finding, okay? So there's a lot of promise here. People are thinking about this because they say, well, this is faster and it's more efficient, okay? There's potential for real-time settlement and a wide range of assets. It's cheaper than trading on existing platforms, or so the claims have made. It's more convenient. You could have 24/7 global trading in some of these things. There are interesting concepts like fractionalization. I can put a residential real estate on this distributed ledger, and then rather than trading that piece of real estate, I could trade shares in that piece of real estate. I'm a little nervous about the idea of somebody like trading shares of my home, but you could potentially do this with tokenization. So what are the questions that we're asking? Financial Stability Board, we think about risks. So we're looking at things like the liquidity. Would the liquidity of these assets that are traded on a distributed ledger, would they be different? How would they behave in times of stress? Would people go to the traditional market, to the tokenized market? Could you use assets that are traded on a distributed ledger that have been tokenized to hide your buildup of leverage by acquiring assets and building up that leverage in a variety of places where it's harder to track you? Would assets that are traded in tokenized markets, or would assets that are fractionalized trade at the same price? Would the sum of those fractionalized pieces equal the sum of the whole? What about all the connections to the traditional financial system? What are they, and how would they behave during times of stress? And then finally, this would be a much more electronic market. It would have a lot more operational fragilities, potentially, than traditional financial markets. I think this is a very profound innovation. We're also working on artificial intelligence. Again, at the request of the G20, we're writing a report on, you guessed it, the financial stability implications of artificial intelligence. This is a follow-up to work we did in 2017, where we were asked to do the same sort of thing, except this time we're focused on some of the new use cases, things like generative AI, which have emerged since 2017 as being more likely to be developing more quickly. I would argue, thinking about that building paradigm, that this is not quite the same as tokenization, which is, to me, ripping out the foundations and building new products on top of it. Some people have talked about artificial intelligence that way, though I like to think of it more as an input that could be used at any level of that innovation. It could be used to help you develop that new foundation. It could be used to develop new products on that foundation or to develop new features. Either way you think about it, I think it's a very profound innovation. Now, in 2017, when we wrote this report, we came up with a list of financial stability implications, and you can see them on the screen there. Things like concentration risk and cybersecurity risks, and you can look in that final one. Model risk is something that a lot of people have talked about. What we're finding now is that with the generative AI, a lot of these risks still apply. If there's one that's getting a little bit more attention, it's the concentration risk, because when you think of generative AI, any regulators out there, when you're talking to the financial institutions, they all say, oh yes, we have our own Gen AI model. And what they really mean is, we have licensed one of these large language models and we've customized it to our particular business, but underlying it are really the same 2 or 3 or 4 large language models, depending on the language family that you're from. So the concentration risk here might be a little bit more profound. I said I was going to deviate a little bit from the digital innovation. I do completely understand that non-bank financial intermediation is not a digital innovation, so I'm not trying to make that claim. But I want to talk about what I think is another profound change that's going to affect the future of the financial architecture. What you see here is just a representation of the shift towards the non-bank sector over the last 15 years or so, where we've gone from roughly 40% of financial intermediation to roughly 50%. 2023 numbers will be out soon. They're back up to roughly 50% is a quick guess. This is a profound change. It's not a digital innovation, but it's a very profound change if you think of that building analogy. The banking sector and the non-bank sector are built on different foundations. They have different sets of rules that govern them. They have different participants. They have different business models. And so when you shift 10% of global intermediation from one to another, you're really building on a different foundation. If this were to continue, and 10 to 15 years from now, we gather together and we say, well, non-banks are now 60% of global financial intermediation, and banks are 40%. Think about the implications of that. This is meant to be a confusing slide, okay? I don't expect you to read all of this. I'm not even sure you can if you tried. What I wanted to show, it's supposed to be a picture of the financial system showing a variety of non-bank players and the banking system. What you should take away from this is the banks are just one small box. It's a bank, it's a box in the middle on the bottom, if you can find it. The non-bank system is very diverse. We refer to it as the non-bank financial system, but it's this incredible array of different players with different activities, different entities involved. So when we talk about a shift to this, we're talking about a shift to a much more diverse financial system. It also means that every one of those has connections to every other piece. So the more we shift there, the more the connections that we're building in, which from a vulnerability standpoint means there's more vulnerabilities to think about. And as I hinted at, this is regulated differently. Most regulators of the non-bank system take at least primarily an approach that is based on investor protection or consumer protection, or it might be market integrity. Financial stability might be there, but it's usually not the leading of the mandates. And I think we all know that in general, this is a more opaque system. We used to call it the shadow banking system for a reason. So understanding the vulnerabilities, developing policies is more difficult. Okay? So I think this is a very profound shift. I'm going to finish on this slide. Just to bring this together and to show why I put non-banks here, I think we have a very rare set of innovations. Tokenization and AI, to me, are very profound innovations. Those don't, financial innovations, they don't occur very often. What the implications of that are is very difficult to predict because we don't see innovations of this depth anymore. I'm not saying they're going to be successful, but we need to think about those implications. It's important to consider those consequences. And I think it's important when we gather in meetings like this to think about other aspects as well. We can't focus on the things that are really hot topics like AI and tokenization and forget about these more mundane, more analog innovations like this shift to the non-bank sector, which I think could also have very profound implications. Thank you very much.
Thank you, John, for walking us through this more complex issues in a very intuitive way. Our next speaker is Mawash Crash, who is joining us today virtually from Washington, D.C. It's great to see you, Mawash, and the floor is yours. Okay, bye.
Thank you, June. I hope you can hear me properly. So let me begin by thanking the organizers for the invitation to participate in this very interesting session. My apologies, I could not be there in person, but technology has allowed me to join virtually through DC, from DC, and it's a real pleasure to join all of you today. So as John mentioned, technology and technological innovation is having a profound impact on the evolution of the financial sector. And in that process, a key risk that has come to the forefront is that of cybersecurity, in the financial sector. Now, despite its importance, it is surprising how limited data is and how limited analytical research on this topic has been to assess the financial stability implications of cyber risk. And at the IMF, we have tried to address this gap by collecting data from various sources and doing some work to assess the cyber-related vulnerabilities and risks in the financial sector, which was published recently in the Global Financial Stability Report of the IMF. And my presentation today would largely draw on that work. So, in today's digitalized world, we are being reminded constantly of the risks that cyber incidents can pose. A recent example is that of CrowdStrike, an event that occurred in July, middle of July, and it affected thousands of people globally by disrupting services across sectors in different countries, from Asia Pacific to North America. And over the years, the number of cyber incidents has increased. It was increasing gradually, but we see a surge around the pandemic, as you can see on the chart on the left-hand side. And since then, cyber-related incidents have remained high. Now, In particular, malicious incidents like cyber extortions or malicious data breaches, which we commonly refer to as cyber attacks, they have more than doubled since since the pandemic. So before the pandemic and now. And this trend of rising malicious incidents, I mean, if we were to do a regional breakdown, it's uniform across sectors, across countries, and but the most pronounced increase has been in Europe and in Asia. Now, these cyber incidents impose substantial costs on firms. On the right-hand side, we have documented direct reported losses by firms. And over the last 3 years since the pandemic, they have amounted to about US $30 billion in real terms. And these are just the reported direct losses. So the total costs, we expect them to be much larger, taking into account a lost business, reputational damage, cybersecurity investments after the attacks, and so forth. On the positive side, we also see that there's a growing awareness and recognition on risks posed by cybersecurity. So we see that, in different surveys of businesses and investors, they are mentioning cyber risks as one of the top risks. In firms' earning calls, we can see a greater mention of cybersecurity, cyber risks, and you can see that, this has surged also since around the pandemic. Central banks, regulators are also viewing cyber risk as a material risk. So not so long ago, for example, Fed Chair Jerome Powell remarked that the risk that the Fed is now keeping its eyes on the most is cyber risk. And so we can see this right-hand side chart shows that, the number of policy documents or the number of times the cyber-related issues are covered in financial stability reports of central banks. They've also been going up, and international bodies, including the FSB, as we all know, have been issuing guidelines and principles on to strengthen cyber resilience. So, how should we think of systemic cyber risk when it comes to macro financial stability? So far, we have not seen any systemic cyber incidents, but that does not mean that they cannot happen. As John pointed out, we are seeing technological innovation, a rapid digitalization, and also an escalation in geopolitical tensions, which means that all these factors exacerbate cyber threats. So one can think of, severe cyber incidents to affect macro financial stability through 3 key channels. First, a loss of confidence. So if a major institution is hit, it could be a financial institution is hit, it could undermine confidence. So for example, in the case of banks, it could lead to deposit withdrawals or cyber runs. Similarly, if the services provided by a financial institution are not easily substitutable, think of FMIs, think of, these GSIBs, or major IT service providers, then a disruption through a cyber incident there could, of course, have ripple effects for the financial system and the economy at large. And then interconnectedness. So financial institutions, they have technological linkages, interlinkages, they are financial interlinkages, and that could imply that a major incident could become systemic. From then there could be spillovers also from the non-financial sector to the financial sector. So for example, a cyber incident at a major infrastructure like electricity grid, etc., could disrupt financial operations. And similarly, incidents at large, non-financial corporates could have an impact on financial institutions. So against this backdrop, what we try to do is to look at the causes and consequences of cyber incidents by focusing on 4 key questions in light of also the data availability. First of all, what factors can explain the occurrence of cyber incidents? And this is an important question to better assess the threat landscape and also to get some policy guidance in terms of what sort of actions could mitigate the risks. How large are firm level losses from cyber incidents? And of course, from a systemic perspective, we care about, the extreme losses. And so how probable those are. How vulnerable is the financial sector to cyber risk? And finally, how prepared are countries, especially emerging market and developing economies, to tackle cyber risk? So in the chapter, of course, we go through all of these questions in a lot of detail, but I would try to give a quick overview here of our key findings and takeaways. So in terms of the factors, the key factors that drive cyber incidents, we find that, of course, both firm-level characteristics as well as country-level characteristics matter. So a firm in a country with weaker cyber legislation or advanced technology, or a country that faces high geopolitical risks, tends to have a high probability of experiencing a cyber incident. At the firm level, larger firms and those with a higher share of intangible assets, which typically are firms in the IT sector, for example, they tend to have a higher probability of experiencing a cyber incident. Now, we also observe analytically that during the COVID-19 pandemic, there was a surge in the occurrence of cyber incidents. And, we explored that a little bit more, and this could partly be attributed to the shift to teleworking. And there, what we observe is that firms that had, on the eve of the pandemic, that could be considered as moderate, having a moderate ability to telework, that is, firms that could telework but were not teleworking in those sectors, they during the pandemic shifted towards teleworking, and they had a higher probability of experiencing a cyber incident relative to those firms that already had a high teleworkability and so were already using, relying on telework before the pandemic. And a key reason for that is that in firms with moderate teleworkability or low teleworkability, cyber governance practices before the pandemic were also weaker, whereas high teleworkability firms were better prepared. Over the years, however, we do see that firms across the board have improved on average, improved their cyber governance. Now, in terms of how large are firm-level losses from cyber incidents, what we observe is that on average, cyber-related losses have been quite modest, so about $0.4 million. That said, there's a difference between malicious incidents and non-malicious incidents. So malicious incidents are much more costly, are about 5 times costlier than non-malicious incidents, and on average cost around $0.5 million. That said, there is quite a bit of, the distribution is quite skewed, and you can see that from the chart in the middle. So you could have cyber incidents that cost quite a lot, in hundreds of millions of dollars. What we try to do is to assess the probability of, what is the probability of such extreme events occurring. And to do that, which is not a mean task, we apply a generalized extreme value distribution approach. And what that shows is in the right-hand side chart, so what the first 2 blue bars indicate is that the probability of a loss occurring, say, in a typical year has increased to about $141 million from 2017 to 2021. But the size of extreme losses, like the kind of losses that would occur once in a decade, that you can see has increased drastically from about $0.5 billion to $2.5 billion. So, cyber incidents that impose such losses could, of course, have a bearing on the operational resilience of the firms, and they could pose liquidity risk, but also in some cases solvency risks. Now, these are direct losses reported by firms. As I mentioned earlier, total losses could be much larger, and we do not have a good sense of that. That data is not reported. So to try to get some sort of, make an assessment of that, what we do is we look at the effect of cyber incidents on stock prices, on the presumption that stock prices are likely to reflect the future market value of the firm. And again, when we do that for all cyber incidents across all firms, which is shown in the left-hand side chart, we do not find any statistically significant effects. But when we focus on malicious cyber incidents, we do find a stock price reaction, a negative stock price reaction of about 0.2 percentage points. And if we were to then zoom in on relatively, so these are all publicly listed firms, but among those, the ones that are relatively smaller, what we find is that they are much more impacted, and there the losses, cumulative losses, could be about up to 0.6 percentage points. And in dollar terms, that translates into a loss of in market value of about up to $90 million. So as you can see, these are much larger costs than the direct reported losses. Now, in terms of the vulnerability of the financial sector, so how vulnerable is the financial sector? The answer is it is quite vulnerable. If we look at the cyber incidents that have occurred so far, about 1/5 of them have been in the finance sector. Among those, banks have been the most exposed, followed by insurers, asset managers, and other financial institutions. And all in all, we see that financial institutions in advanced economies, which is shown on the right-hand side chart, they tend to be more exposed to cyber incidents than financial firms in emerging markets and developing economies. But what we observe is that financial institutions in EMDEs are also quite notably exposed, and more so than their non-financial counterparts. So now there are several characteristics of the financial system that make it quite vulnerable to cyber incidents. Of course, financial institutions hold a large amount of important information, customer information on financial transactions, that makes them quite, vulnerable or lucrative targets for hackers. But in addition, there are also some characteristics of the financial system which suggest that any cyber incident on one financial institution could quickly, have a domino effect. So as we know, market concentration in the financial sector tends to be quite high, of banks, of financial market infrastructures. So both at the country level and at the global level, and this is particularly true for payment services as well as custodial services. And so any attack on one of the major banks could really have spillover effects very quickly. Then the other thing is that major banks or financial institutions tend to share IT suppliers. And this is extremely important, and it was very difficult to collect data on this, but we thought it was very, very important. And what we found was very striking, which is that 50% of the IT suppliers to GSIBs are actually also supply their services to 2 or more GSIBs, indicating quite a significant degree of overlap. And what this means is that any shock to an IT supplier could have a major impact. And this needs to be taken into account in risk management practices. And finally, interconnectedness is also extremely high in the financial sector, within the financial sector, and between financial sector and other sectors, including the IT sector. And so our data allowed us to look at the second round effects of a cyber incident. And you can see from the complicated chart on the right-hand side, and what it shows is basically that if you have an attack that happens in the finance sector or financial sector or IT sector, then it can quickly transmit into other financial institutions or the IT firms in the IT sector or in other sectors. Now I would just like to very quickly touch upon the third channel, which was I mentioned earlier, which was actually the first channel on my earlier slide, about loss of confidence. So we may think of this as a theoretical construct that there may be cyber runs possible through a depositor withdrawal, because we have not seen such cyber runs happen so far. But actually, if we look at the data, what we find is that, yes, overall, if you have the full sample of banks, we do not find any strong evidence of cyber runs because we have not seen, as I mentioned already, such kind of attacks at major financial institutions imposing very large losses or impeding services. But if you look at smaller subset of banks in the United States, what we do observe is that after a cyber incident, there is evidence of deposit outflows in cumulative terms of about 5% for wholesale deposits, for example, 6 to 7 quarters after a cyber incident. So clearly, what it indicates is that if we have a major incident, it could lead to potentially undermine confidence among depositors and lead to cyber runs. So how prepared are countries to tackle all these risks and vulnerabilities? So here, we put together data on the level of preparedness at the firm level as well as at the country level. We looked at different indicators put together by different providers. And so on the left-hand side, you have this is firm-level data of cyber vulnerability across firms put together by a firm called BitSight. And so they do assessment, cybersecurity assessment across firms. And what we see here is that two key takeaways: that on average, firms in emerging markets and developing economies are less prepared. They have weaker cybersecurity levels than advanced economies, but even in advanced economies, there tends to be quite a significant degree of variation. And overall, in terms of cyber legislation and overall at the national level in terms of cyber security preparedness, what we observe is that emerging markets, again, there are gaps there, but there has been some improvement over the years. So that's an encouraging sign. And this thing is also confirmed by an in-house survey that we have started to conduct at the IMF, where, so it's a survey of central banks and financial regulators to assess their overall cyber preparedness. So many questions are asked regarding the national cybersecurity legislation as well as regarding their cyber-related regulation and supervision. And from that, an overall index on cyber preparedness is created that ranges from 0 to 5, with 5 indicating higher preparedness. And so far, the survey has been carried out in 2 years, 2021 and most recently in 2023. And you can see from the chart on the left-hand side that over in the last couple of years, the cyber preparedness index of several countries has, among emerging markets and developing economies, has improved, and they're now scoring, as 4 or 5. That said, there are still at least 50% of emerging markets and developing economies that do not have such a high score, and we consider them to have quite inadequate cyber frameworks. So there is quite a lot of work to be done. If we look at a regional breakdown across of this index, what we observe is that countries in Asia and Africa, on average, have the weakest level of cyber preparedness. But again, there's quite a bit of heterogeneity across countries. So to conclude, how can cyber resilience be improved? Now, of course, strengthening cyber resilience at financial institutions is important, but private incentives to address cyber risks may not align with the socially optimal level that is necessary of cybersecurity. For different reasons, they may not internalize the externalities. They may not have information on common risks. They may not have information on threat levels, and so on and so forth. And so all this makes it necessary for there to be public policies to play a role. And in that regard, both there needs to be steps taken at the national level as well as financial regulation and supervision are key. So at the national level, there needs to be a cybersecurity strategy that identifies critical infrastructure, plans a response in case a cyber attack happens, as well as leads to greater awareness among people on cybersecurity issues. There need to be cybersecurity laws to criminalize cyber attacks, and then this risk of cyber incidents leading to sort of having a systemic impact needs to be integrated in crisis management frameworks. Effective regulation and supervision are, of course, key. There's a lot that can be done there, but so I'm not going, this list is not mutually exhaustive, but just to cover a few key elements. Countries need to establish adequately skilled and staffed cyber risk supervision units to ensure good on-site and off-site monitoring. Firms reporting, so frameworks need to be set up to strengthen firms' reporting of cyber incidents and information sharing, and that is really critical. Then there should be a mapping of interlinkages between financial firms and technological firms to identify potential systemic risks in case a cyber incident happens. So cyber maturity among financial sector firms needs to be encouraged. And what that means is that there should be proper cyber hygiene at firms, training and awareness, as well as board expertise on cyber matters. Finally, there need to be proper response and recovery procedures. It needs to be ensured that there are proper response and recovery procedures at financial institutions, and they need to be regularly tested with different scenarios and to ensure that financial institutions remain resilient, operationally resilient in case a cyber incident happens. Finally, given the cross-border nature of most cyber incidents, so not only are we seeing an increasing number of cyber incidents originating in a different, from across the border, but also given that there could be massive spillovers, given the interconnectedness, global interconnectedness, it's crucial international cooperation to mitigate the risks by developing international protocols, as well as harmonization of reporting of cyber incidents is key. So let me stop here and thank you for your attention, and I look forward to the discussion.
Thank you, Mabash. Thank you for a very comprehensive and sorry. and detailed presentation about cyber risk. I bet Mabash and her team made a lot of effort to assemble the data. This kind of data I have never seen before, so it is really welcome, more than welcome for all understanding. Now, because of time constraint, I think we have to move fast. So next, the first discussion is Xiaonan Zhou, so please take. The floor is yours. Let's go ahead.
Thank you. Thanks very much. Thanks very much for our conference hosts and conference organizers for inviting me here today. It's my tremendous honor to be here and sharing some of our industry experience with everyone here. John, as well as Mabash, just given us a really excellent presentation about cybersecurity, AI, tokenization, innovation, etc. A lot of things they have said really resonate with my professional life and a lot of priorities that we are having today within the bank. In the next 8 minutes, maybe, I will try to fast-track my conversation and focusing on 3 themes. Number 1 is why tokenization and innovation is so important, what's the benefit it brings. Number 2 is what the challenges we're facing today? Why have we not seen the scaling and large-scale adoption by the industry? And the third thing that I would like to mention is what shall we do to make this journey fast and furious? Okay, starting with the first point, why tokenization innovation is so important. Bring everyone back a little bit to the background. Thinking about the financial industry today. The financial industry today is very much based on a patchwork of financial intermediaries and the fragmented counterparty relationship. This means moving securities and cash across different parties within this industry is costly and is complex, and as a result, it creates liquidity cost and it also creates the settlement risk. Together with the fragmented custodian and intermediary landscape, we also have the challenge of not able to settle or move securities against securities and securities against the cash on a simultaneous basis. This means we are exposed to credit risk, counterparty risk, liquidity risk. As a result, we have to put the collateral in space, we have to put the buffer in space, and guess what? Sometimes we have to even put buffer above buffers to make the settlement risk being remediated. The buffer and the collateral we put in place are very often high-quality liquid assets, including cash. And as we know, they are very scarce financial resources and expensive for banks, and as a result, expensive for the clients of the banking industry. So, as Ron mentioned today, tokenization really bringing in a promise or the possibility to have a profound foundational change to the industry. Why the tokenization can help us? As we said earlier on, tokenization helps us to digitalize and represent ownership of securities and the cash onto a blockchain, so the settlement can happen simultaneously, real time, very much traceable and transparent. We have already proved this possibility back in 2019 when we actually tokenized a basket of high-quality government bonds and exchanged the ownership with a basket of corporate bonds held by another large financial institution. So these SEC lending transactions happened on the blockchain or on the tokenization basis can already prove that we are able to do simultaneous settlement on the blockchain and reducing the settlement risk and free up more liquidity, which were previously locked elsewhere. So this is a typical example of how tokenization can help the capital market. But what about transaction banking? It is certainly helpful as well. Transaction banking, just to remind ourselves, is the side of the business that helps the international trade, the export finance, the movement of the cash and the liquidity for corporates and institutions. In the transaction banking today, a very long-standing pain point is the cross-border payment, which we know is also a G20 priority as well. So the cross-border payment is expensive and sometimes is slow and with a lot of uncertainty. So distributed ledger or the tokenization can really help here because, as John mentioned earlier, we can also tokenize cash and deposits on the blockchain. And when such tokenized deposits or a network of tokenized deposits is adopted by a large number of banks and correspondent banking or transaction banking, the movement of the deposit can happen in a very seamless way, very traceable. So we will no longer have a situation where my colleagues and myself sometimes joke about, we call it fire and forget situation. So in today's world, you fire a transaction, the minute you can forget about that because you lose transparency, traceability. But with the help of the tokenized deposit, we will be able to create the traceability, transparency, and be able to really guarantee the settlement efficiency, reducing the cost and reducing the liquidity cost for the banks and for the customers. So this obviously directly contributing to the G20 target of improving cross-border payments. Now we have talked about the use case of transaction banking, the use case of a capital market. You might be asking me, why have we not seen the adoption happening fast and furious? So now this coming to my second point, the reason why this is so challenging. The reason this is going really, really slow, having multiple reasons. For example, expensive infrastructure investment. For example, the uncertainty within the regulatory and the legal landscape. But one thing I would like to quickly zoom in today is the importance of the network effect. And this also matters to what you said, John, earlier, the liquidity. because the liquidity, you call it 3 words or 1 word, is the single most important thing I would like to emphasize today. Because without liquidity or a network effect, we could not move in this journey fast enough. And why is this important? Because if we do not have a network of banks and financial intermediaries adopting the same technology or having a way to connect with this tokenized world in a seamless way through traditional technology or through a digital technology or through any sort of bridge or fancy words you call it, we are not going to have the liquidity. So that is precisely the reason why in 2022, when my team launched the first UBS digital bond, which was a 375 million Swissy OPCO bond, we pushed successfully to have this bond to be able to straddle across both digital and the traditional world. Because only by having such network, you can achieve the liquidity. You can achieve that this bond can be accessible by investors like they access any other traditional UBS digital bond we have launched in the bank's 160 years history. Now, I think let's quickly wrapping up to the third point of what can we do better to make this journey better and smoother. First thing I would like to mention is we need to be really truthful to the use case, to the operating model, to the product, and to the client needs. We should not see this as a technology topic. We should see this as a transformational opportunity to changing a lot of foundational architecture and the business model of this industry. So here, I think, very self-explanatory. But a second thing that I would like to mention in terms of how to driving this journey faster is the collaboration. I mentioned very briefly earlier, a network effect is important across the private sector. People are collaborating already, but something also very important is the collaboration between central banks and the commercial banks, the public and the private sectors. Why is that important? Because I think we are playing a very important role to supporting our central banks, policymakers, and the regulators in assessing and pushing more understanding in the tokenization, in the impact of central bank digital currency, CBDCs, and also in understanding and assessing the impact to the new monetary policy, the potential of capital flows, the potential to the FX market, and etc. Last but not least, I think I would like to maybe draw everyone's attention back to this great country. We know Korea has been doing a lot of great stuff in terms of pushing wholesale central bank digital currency. I know you are part of the project Agora, which is the BIS flagship project, joint force by 7 central banks, including the Bank of Korea. I think it is a great sign of showing the future of this journey is going to be a great partnership between private and the public sector. I think yesterday we were celebrating the Bank of Korea hitting 2% inflation target. I think maybe to wrapping this up with some blue sky thinking, maybe one day we will see tokenized deposits and tokenized central bank digital currency and tokenized government bonds all being used as humble tools in an innovative way for the central banks to achieve this inflation mandate in a very different world. So this is everything I'd like to share. Thank you.
Thank you. And now my next discussion is Sang-Wan Yoon. Okay. So, floor, please.
Thank you very much for inviting me. I'm going to comment on cyber risk in the second presentation. Actually, Dr. Kurashi provides, I think, a comprehensive view of the current cyber threat landscape and its potential impact on financial stability. She also has suggested a thorough list of measures to address these issues from regulatory and supervisory perspectives. However, one measure in particular, she mentioned that this is reporting of a cyber instance, information sharing. I think it needs a more nuanced examination based on the real-world implementation challenges. as an overseer of a national payment system, various kind of payment system, including large value payment system. So we, Bank of Korea, keen on managing cyber risk. I think several years ago, if I correctly recall, that we initiated a discussion with payment system participants, mainly commercial banks, regarding information sharing in response to then cyber risk incident. Actually, at that time, it was a big cyber risk incident that happened. So we gathered with central bank, not only central bank, but also the commercial banks. And then during this, the conversations and meetings, significant challenges emerged. So we discovered that encouraging IT employees who is responsible for cyber security to voluntarily share instant information with other participating commercial banks are exceptionally challenging in practice. This is despite the fact that such a shared information would greatly contribute to overall safety of a payment system and also improved operation of other commercial bank systems. The primary obstacle we found is for information sharing is a reputational risk. IT employees at the time expressed a concern about a possibility that shared information could be leaked to the public, so the potentially damaging their institutional reputation and trustworthiness. So to address this issue, we recognize the necessity of constructing more deliberate and well-designed incentive schemes. This framework may need to include the following, something like that. I just did come up with at the time. The first one is that motivate IT employers share critical information. Second is that alleviate concerns about the potential negative consequences. Third, ensure the confidentiality and the secure handling of the shared data. So that is, I wanted to add value on the top of what Dr. Kurash made on the measures. I also turn to the second perspective I wanted to share. As I mentioned before, the cyber risk is a critical issue for the Bank of Korea. So we directly operate financial market infrastructure, specifically large value payment systems, the BOK wire. So US case is a Fed wire. And are also actively engaged in research and in development of central bank digital currencies. So in my view, because I've been in the payment system area for more than 14 years, and then I've really engaged in some kind of operations. So in my view, most central bank operated large value payment systems, I think it face relatively very low risk of cyber risk because that limited access, because the access policy, because that for US, only depository institutions have a current account with the Fed, and in a EU ECB case, I think most of the participating institutions are credit institutions, so most of the banks. So the number is very limited. However, introduction of CBDC may significantly alter cybersecurity landscape for central banks. With the CBDCs, central banks will have more system to manage beyond the existing large value payment system, along with a great number of participating institutions. For retail CBDCs, diverse range of payment service providers, including traditional banks and then e-money service providers will be involved. So this expansion will increase the number and the variety of institutions that central banks must oversee and interact with, potentially complicated risk management. In the case of wholesale CBDCs, providing these currencies to various digital asset platforms. Like that in Korea, and many security companies, our commercial banks are preparing for operating security token platforms. So I think a couple of years later, we have I think probably more than 5 platforms will be pop up, and then. So we have to, at the time, we have to consider that as a central bankers, we have to provide secure settlement of assets to those platforms. So definitely that means that the central bankers have to interact with those security token platforms. So I think of solutions. I think on top of Dr. Kurashi's suggested measure to mitigate the potential cyber risk, I want to add the importance of public sector's engagement. Not only in intervention, but it's engagement in technical solutions, particularly for like the institutions like the central banks. The Bank of Korea now is exploring innovative technological solutions to ensure data integrity and confidentiality in our CBDC experiments. So the first is to secure data integrity. I think that a distributed ledger technology is kind of a viable option. I think that in Korea, there's a DLT, blockchain is tainted with speculative investment. But in my personal opinion, this is a viable option. Because it can prevent data tampering at the source and then secure consistency across systems. So while you might raise questions that I think because the blockchain, the data, transaction record is recorded on a blockchain platform, so it's transparent. So you might have concern about the data confidentiality. But we are investigating the application of cutting-edge encryption technologies to address this issue in collaboration with the research universities. So I think I'm going to introduce 2 solutions. One is that zero knowledge proof, which can verify the validity of a transaction without revealing any critical information. That's a good thing. Second thing is homomorphic encryption, which allows the data to be processed while being encrypted. So it is minimizing risk of privacy exposure. So in sum, addressing a cyber risk requires, I think, a multifaceted approach. So this should involve not only public intervention and regulation, oversight, or supervision, but also I think also the development of advanced technologies. So I want to emphasize again that the public sector needed to be more proactive in seeking, I think, technology solutions out there. And then, if possible, I think engage more directly in the development of these technologies. I'm going to stop here.
Thank you very much. First 2 discussants have sort of like a designated discussion on each presentation, and now finally our Oliver Wunsch, you are supposed to make a more balanced wrapping up of presentation.
Excellent, thank you, Chair. So let me first also thank the Bank of Korea, the Ministry of Finance, the KDI, and Marc Guzon for inviting me to this great conference and to the panel. It's actually my first time in Korea. And being the last speaker before lunch, we are now clearly in the territory of everything has already been said, but not yet by everybody. So let me try to keep my intervention focused. Specifically, I will argue that our current incumbent banks, given the way that they are structured and how they are managed, might be ill-prepared to positively leverage the technological revolution, and this could expose us to financial stability risk. So let me focus on AI, as this topic has not been that much covered so far on this panel. When in our work with the banks, and I'm now speaking as a financial advisor, we talk to their leaders about what their ambitions and objectives are for using artificial intelligence, it becomes clear that they mostly have one thing in mind, and that is cost savings. If you look at how a CEO of a bank spends her time, most of it is devoted to keeping a vast operation humming and to keep demanding investors happy. They are much more managers than economists. And given the earnings side of a bank greatly depends on the macro environment and the long-run economic cycle, something that they can't really influence, managers love focusing on process and cost. The cost mindset is actually very important because it shapes the narrative. Compared to a growth story, a cost story makes it difficult for managers to justify bigger investments, to motivate staff, and it defines how they approach the matter and the constraints they face. So what are these? First of all, banks face the challenge of getting the necessary talent. If you are an AI expert looking for a job, where would you go? Would you go to a technology company where you work on building their core offering and that makes you enjoy a vibrant, innovative environment with high pay, partially in equity that is expected to rise in value? Or would you go to a financial behemoth where you are providing a tool to augment and deliver their product offering, and where large parts of the organization, investors and clients see you, the great AI expert, as a cost driver? And banks are slow. A technology company can move fast and break things, and this is the claim that Mark Zuckerberg put down for Facebook. At a financial institution, it takes 1 year to get a simple change rolled out from a development to production environment. This is due to a maze of legacy systems that cost a fortune to maintain and where changes are risky. But it is also caused by grueling process requirements that again are driven by operational, audit, legal risk considerations, and actually less so by regulators, even if bank managers would tell you otherwise. This is not only relevant in technology, in product development, everywhere you have this kind of maze that you need to navigate, and it creates an environment that in fact is anti-agile. For the same reason, the so-called internal incubators don't really work, because at some point they quickly face a bank's machine and as their innovation needs to be rolled out. The third thing is risk awareness. Many AI use cases are frontier innovation and to some extent even basic research and expensive. This means an investment taken in the area could fail, and banks do not have this investment mindset outside their core business. This is not only a management issue. Quite importantly, it's also driven by investor preferences that banks managers need to observe. And then there is data. Banks do have lots of data that they can use and that they have always used to train models, including internal ratings and so on. But modern AI models require a vast amount of data that normally are not held or accessible to banks. All factors considered, what does it mean? We will see that increasingly core elements of a bank's value chain will move over to technology providers, and this is absolutely true for the smaller financial institutions, but also to a large extent even for the biggest players. And then a dynamic sets in that has for several times been observed in other industries. After some time, the outsourcing firm gradually loses the know-how to do the outsourced things themselves. At some point, it will be even impossible for the banks to challenge their providers, as the knowledge to do so effectively is not available anymore. Finally, combined with the increasing market power of the technology companies and their rising competitive edge, they will come for the margins of the banks as their clients. And there is a nice quote by Jeff Bezos, the founder of Amazon, saying, "Your margin is my opportunity." Threats appear also from other directions. We could mention the slow move toward private credit, something already very important in the US and that we gradually see in Europe growing, and the broader NBFI developments that John has already discussed. Retail CDBCs challenge another competitive advantage banks enjoy today, the need to have a bank account to do cashless payments. Payments is a low margin business, but is the entry door of selling other products, including lending or advice to clients. If this connection is severed, it's much easier for clients to move, which will again compress margins and impact profitability. We don't have the time today to discuss, but to me is also, this is quite important in terms of how to develop the business model. In the end, the business model of banks, which relies on their exclusive access to central bank money, market presence, process and technical knowledge, as well as information access, will be broken up and fragmented. Now one could regard the change of its institutional landscape as a bad thing, alas it's not. It would rather be strange if the landscape that established itself not only to provide financial services, but also to overcome constraints of the day, for example on how to gather information, how to minimize settlement risk, which was mentioned, would not be revisited given the new responsibilities and possibilities. But the way that we think about financial stability needs to expand further. After the great financial crisis, we did the first step by looking at financial markets in a more integrated way. And the foundation of the Financial Stability Board, from its origin as a Financial Stability Forum, certain local or regional establishment like the FSOC in the US, is a testimony to that. But supervisory actions, they need to be based on the law. And that in many economies still thinks of the financial system being siloed, which then is also reflected in the way that supervisors are organized. Now we face the next expansion. As important value chains get outsourced to tech and AI providers, we need to think how to deal with this, also from perspective what these providers do, and considering some of the players are even more systemic in their realm than the big GSIBs are in theirs. This will require cooperation across regulatory domains, including competition authorities, and will come with jurisdictional and sovereignty concerns. We will need to ask ourselves if the vast concentration that we see in the technology sector should be accepted, and if not, whether the business and technological dynamics have already closed the door for less concentrated setups. Further, we will need to think about what it makes up a sustainable bank business model. After the collapse of Credit Suisse and the regional banks in the US, this is already very high on the agenda of regulators, but it might be that we need to do these considerations in a much more longer term strategic and with a structural view. Finally, let's have a quick look at monetary policy. Banks are vital for the implementation of monetary policy, as we all know. They help the central bank's rate decisions pass through to lending and deposit rates. They are the most important counterparties for open market operations. They are covered also by extensive statistics and reporting requirements, some of them even in near time, which allow central banks to optimize their measures. In a world in which banks are less important and the markets are more fragmented, monetary policy implementation will also become more difficult. Banking is necessary, banks are not. That is what Bill Gates said at some point. I'm actually very confident that we will always have banks, even if their shape will change. Also, whatever financial system emerges in the long run, it can be at least as efficient as the current one, but we need to anticipate this and adjust our policy tools, and we need to be prepared for a very bumpy transition. Let me stop here.
Thank you very much, Oliver. We are pretty much kind of close to our time limit, but by using my prerogative as a moderator of this session, I'd like to ask one question to John and then one question to Mabash. My first question to John is about, probably you can say something tell us something about the regulatory challenge arising from the combination of tokenization, AI, and NBFIs. I'm sure there might be some overlaps among them. For example, if NBFIs are more likely to adapt AI or tokenization much faster and more than banks because they are less regulated, does this mean the NBFIs are become more even riskier or growing faster? That may create another challenge down the road on the regulation side. And before you answer that question, I will ask the question to Mabash. We heard about something about cyber risk, and there is a financial losses. Distribution pretty much has a fat tail. There's a very large amount of things. So I presume that market may have some solution, not perfect one, but something like insurance. Is there any insurance? What kind of role they play, and if they are playing some role, how prevalent is it? So that is my question to each one of us. So John first.
Great.
You have 1 minute, I'm sorry.
Okay. Wow, that's quick. In terms of regulatory challenges, think of something like tokenization, where we heard about how difficult it is to get started, for example. Right now, in some sense, it's too small to matter for us to begin to regulate. So that might be one thing that presents a challenge. When do you actually start to regulate? Or think about artificial intelligence, where I have some members who want us to start making regulatory recommendations Others who say there are existing regulations on third-party service providers that we can utilize. And then I have others who are saying we don't even have the legal frameworks in place in our nation to handle all of the data issues and other issues. So I have members who are into 3 different camps. So those are 3 different sort of, do we even start to regulate? And then you mentioned the MBFI, and let me bring that in. It's not that it's not regulated, it's just regulated differently, so they see things from a different perspective. The FSB's membership consists of finance ministries, central banks, securities regulators, and other international institutions. So to get to agreement on regulation, you have to agree amongst a group of institutions that have different mandates in terms of what they're doing, that it's time to regulate for financial stability purposes. So that's the best I can do in 1 minute. Otherwise, we could have a whole session on regulatory challenges.
Okay. Thank you very much. Now, next turn to Mawash. Just go ahead.
Yes, thank you, June. So I presume I also have 1 minute. So on your question, but let me first also thank the discussants for their very interesting and useful discussions. So on the question of cyber insurance, yes, cyber insurance exists, and it could definitely play a role in helping firms to mitigate losses. So there is no very good, we do talk about cyber insurance in the chapter, but there's not very good, no accurate information on the extent of cyber insurance across countries. Nevertheless, from what data we have, what we observe is that there has been an increase, so along with the increase in cyber incidents, there has been a pickup in cyber insurance also across firms. And if I remember correctly, some of the statistics there, so around 10 years ago, for example, the number of new cyber insurance contracts was less than 40% of the total number of standard insurance contracts. But now it has been, over the last couple of years, it's been the same. So, firms are becoming increasingly aware and relying on cyber insurance. That said, what we also observe is that it's mostly prevalent in the United States and in some other advanced economies. And again, the range is typically, so most of the coverage is around, I would say, $1 million, but there are, the maximum that we observe in the data is a coverage of $10 million. Now, again, there's a question about when you are talking about losses of, billions of dollars, can that be covered by insurance firms? So there are several, we also observe several impediments to widespread availability of cyber insurance. One of them, again, being lack of data. So there is very limited data that is available, say, on cyber incidents. There's uncertainty around the nature of attacks, the total losses, etc. The extent, even surprisingly, to the amount of, the cybersecurity investments being made by firms. There is no good data on that. And these could make it difficult for insurance firms to, of course, price in terms of, how to price their policies. The other thing I just wanted to mention was that given the rise in cyber incidents, we also see that premiums of cyber insurance have been increasing quite a lot. And that could, again, discourage some smaller firms or medium-sized firms, to take up cyber insurance because the premiums are increasing. Finally, I just want to mention, and that was also in the context of CrowdStrike, for example, when you had an outage like that with many firms being affected, there's also a question of then total losses, that insurance firms would have to bear. So there are some estimates right now that circulating that, the total cost would not be around like $10 billion or something like that. I've not seen a final number, but that was what was being reported in terms of estimates. But so one thing that would then we also need to take into account is that, the resilience of the insurance sector in the face of if we are seeing these extreme losses occurring and how resilient that would be. And so that also implies that we would need to do proper risk management and stress testing of the insurance sector to rising cyber risks. So let me just stop here.
Thank you, Mawash. We have very interesting and exciting and illuminating discussions and presentations today, and we learn a lot. And actually, we dive in the morning session. The first session was over 30,000 feet stories, debt challenges, macroeconomic challenge, but now we are diving into the more micro level issues It was quite a fascinating stuff. And I really appreciate your contribution to this session. And with my sincere apologies for making you much hungrier, thank you very much for joining us today. Thank you.
Thank you very much. We deeply appreciate our speaker for the great discussion on digital finance and AI and tokenization. And thank you very much, Professor Kim, for guiding in that session. So from here, we're going to conclude the morning session and we're going to have a luncheon. And the lunch will be served at your seat. And if you don't have a lunch coupon, please proceed to the registration desk and scan your name tag. We'll resume the conference at 2 p.m., so please enjoy your meal. Thank you. A friendly reminder for our participants, we have a very limited sitting, so for those who place their belongings on the seat next to them, please kindly remove to allow other participants to take a seat for lunch. And the participant sitting at the back without a table, please feel free to take any empty seat at the front. Thank you. The fifth session of the 2024 Global Economy and Financial Stability Conference will be beginning shortly at 2:10. We kindly ask all distinguished guests to have attended the conference to please take your seats. Once again, and the afternoon session of the 2024 Global Economy and Financial Stability Conference will be begin in 10 minutes. We kindly ask all esteemed guests to have attended at this conference. Please kindly be seated. Thank you. So, ladies and gentlemen, the next session of the 2024 Global Economy and Financial Stability Conference will begin shortly. We kindly ask all esteemed participants standing in the lobby, please kindly make your way to the hall and be seated. And we do provide a simultaneous interpretation for this afternoon session as well. Please take advantage of the device in front of you. Channel number 1 is for Korean and channel number 2 is for English. As soon as all the participants have seated, we're going to proceed with the next session. Thank you very much for your cooperation. Thank you for joining us again. We hope you enjoyed the delicious lunch and had the opportunity to connect with each other. Now we're all refreshed and energized, then let's delve back into our session. We now proceed with the fifth session, the high-level policy panel, and the title of this session will be A Bretton Woods and a New World, Navigation and the New Economic Landscape. And the chair for the fifth session will be Mark Wujen, the Executive Director and the founder of the Reinventing Bretton Woods Committee. So ladies and gentlemen, please join me in welcoming our chair, speakers, and discussant with a warm round of applause.
Thank you. Thank you. Good afternoon, everyone, and apologies for the short delay for kicking off this session, but this is a high-level policy session. We have an outstanding group of experts. Before we start our conversation, let me first, at the outset, thanks KDI, the Ministry of Finance, and the Bank of Korea for their hospitality and also agreeing to put this conference together. And indeed, this is the 80 years anniversary of the Bretton Woods Conference. And it seems logical to have this conference here in Korea at the time where the G20 Working Group on the Global Financial Architecture will be meeting. And all of you here, and even ourselves, are almost linked to the IMF and the World Bank. So the timing of this conference also coincides, as I mentioned, with the 80 years anniversary. And as you know, the IMF and the World Bank are also embarking on internal and external thinking about their future. And they will be, at the end of this month, a special event that will be held at Bretton Woods, at the end of September. And I'm pretty sure there will be other opportunities to reflect about the future of the global financial architecture. And this conference at Bretton Woods, I think, is the beginning of an initiative that the IMF is launching with the World Bank, really to reflect and to try to ask a small working group to think first about the future of the global economy, and two, about how international cooperation will be orchestrated in the medium term in a world that is going to become, and is now, more fragmented. And this renewed interest stems from the recognition today that the world is very different from the one that was there 80 years ago in terms of geopolitics, in terms of economics, and its use of technology. Both institutions need to find new ways to work in a very divided world where the challenges are in many ways as big as they were in 1944. But all agree here that maybe where we can clearly accept this thinking is that the global economy needs more growth that is going to be more green and more sustainable. So this is a context which we need to achieve will have little resemblance to what it was 80 years ago. So the way we have been thinking about these conversations, as we have an outstanding group of speakers, is clearly to provide comparative advantage. And I'm very pleased that Yong Song-Ching, the economic advisor and the head of research of BIS, will be with us on the online participations. And I will ask him first, clearly, to try to give us a view about how the global financial system will look like in the next decade, but also clearly, as we discussed today and this morning, clearly how he sees this financial system. We talk about tokenization, we talk about CBDC, so that will be the first conversation that we will have with Yong. We will follow with Professor Jacob Frenkel. Jacob is a well-known scholar, but also former chief economist of the IMF, former governor of the Bank of Israel, and the chairman emeritus of the Group of 30. And Jacob has been involved for his decade and for his long journey to look at clearly how international cooperation was orchestrated at the time of Bretton Woods in the sense of the 80s, 1990s. What can we learn from that experience in terms of cooperation in a world that is now more fragmented and where geopolitics take prominence? We will follow after with Andrew Cheng, who is the chairman of Georgetown Institute of Open and Advanced Studies, to try to give us maybe some thinking about how the international monetary system will operate. We have been talking recently a lot about weaponization of money. We have been talking a lot about reserve currencies, and where Andrew is coming from, he is based in Hong Kong, to try really to understand, or Malaysia, is RMB, will become also a reserve currency in the next 10 years. Last but not least, when we are going to think about the source of growth, we need to think about, and we talk a lot today about the resilience of emerging markets. And in a world where maybe globalization will be different, that we might be doing a different form of globalization, I will ask Rakesh Mohan, who is the President Emeritus and Distinguished Fellow at the Center for Social Economic Progress in India, but also as a long-term career as a former Deputy Governor of the Reserve Bank of India, has been involved in G20 for many years, to try to look how emerging markets might shape global governance and are also going to be the driver of global growth. Last but not least, after listening to all of this, Pablo Moreno, who is the head of the Independent Evaluation Office of the IMF, we try to reflect clearly about what needs to be changed within the IMF, what might be the new rule of the game for the global financial system and the global financial architecture. If we not take a view from the IMF, because it's part of the Independent Evaluation Office, but also the challenges moving forward, how difficult it is to reform and try to understand what will be next on the horizon. So to kick off, let me also take this opportunity to thank all of our speakers who have been traveling, but also the ones who are also online. And I will try to start with Yoon. Yoon, over to you, and thank you very much for joining with us, please. And you are around 8 to 9 minutes.
Thank you, Mark. It's a real pleasure to join you and the other panelists, and thank you to the organizers for this very kind invitation. What I would like to do, as Mark outlined, is to set the stage for the panel discussion by reviewing some recent events and drawing some lessons that I think will be of relevance for the very big questions that Mark has laid out. So if we think back to the last 2.5 years, beginning in 2022, inflation reared its head again, and monetary policy has reacted very forcefully in the fight against inflation. And what this has meant is that there have been very broad repercussions to the currency market. So beginning in 2022, many advanced and emerging market currencies depreciated sharply against the dollar. And while some currencies have come back as inflation has eased and the prospect of the rolling back of monetary tightening is on the horizon, there have been other more notable recent moves, both in advanced and emerging markets. So here you see 5 currencies. The blue is the yen against the dollar. The purple is the Korean won, and the red is the euro. And you see this pattern where initially all 3 currencies depreciated against the dollar, and then it appreciated somewhat at the end of 22. Then these currencies have diverged. Now, interestingly, if we look at the Mexican peso and the Brazilian real, in fact, both of these currencies did extremely well in the early stages of monetary tightening. So here, the Mexican peso is in yellow, and the Brazilian real is in orange. And both currencies actually appreciated against the dollar. They strengthened against the dollar in spite of the very sharp monetary tightening in the US and other advanced economies. And we have written, the BIS has written about some of the reasons why this has been the case, notably the much more front-loaded and anticipatory monetary tightening from both Mexico and Brazil. So Brazil and Mexico anticipated the outbreak of inflation and actually moved ahead of many of the advanced economies, which supported their currencies. However, this year, as we go to the right-hand side of this panel, we see that both Brazil, and Mexico has seen very sharp depreciations. And much of the commentary behind the recent financial market moves has involved the role of the yen and the so-called yen carry trade, where the carry trade is the financial transaction where a market participant would borrow in a low interest rate currency and invest in a high interest rate currency. And because both Mexico and Brazil has maintained fairly high policy rates, it was a very attractive destination for the yen carry trade. And one of the questions that many market participants have raised, especially in the light of the recent market turmoil in early August, is how large was that yen carry trade? How does it relate to the broader global financial system? And what do the recent events suggest about the future trajectory of currencies and financial stability? So I will spend a couple of words on that using the swaps market, the FX swaps market. It looks like, Mark, can you see the titles of my slides? Or maybe I'm not projecting correctly, but I have sent my slides to the organizers. So Mark, can you see the titles of my slides? I can't hear you, Mark.
We can see the slide, but not the title.
Okay. Then something has gone wrong in the slide. So let me just explain what this is. So this is the total outstanding amount of FX swaps from the BIS over-the-counter derivatives statistics. It's a 6-monthly series where every 6 months the BIS compiles the outstanding amounts of FX swaps in all currencies. And the units here are very large. So these are in trillions of dollars. So this is trillion with a T. So these are very, very large amounts. And you see that in the legend, the fastest growing amount of the FX swap segment has been the swaps between the dealers and other financial institutions. So rather than the non-financial users, it's really been the financial users. So now that we can get rid of the dealer segment because that's really the intermediary part of this market and just see the relative balance of the financial and non-financial uses of FX swaps. And you can see that the fastest growth has been in the financial uses. So let me remind you what an FX swap contract is. So in an FX swap contract, one party delivers one currency in return for the other currency in the transaction with the promise that they would reverse that transaction at a fixed point in the future at an exchange rate that's agreed at the outset. Now, you can interpret that in many different ways, but economically, this is very similar to a borrowing in one currency by pledging the other currency as collateral. And one example would be the use by an importer or an exporter. So let's take an exporter. An exporter would like to hedge the export receivables, which will be received in dollars, let's say in 3 months, but has to finance the production at home, which is in domestic currency. So if I'm a Korean exporter, I will receive some dollars 3 months from now, but I have to pay my workers and other costs in Korean won. I could enter into an FX swap contract where I borrow dollars by pledging Korean won as collateral. But that will be part of the blue line, where it's the non-financial customers who are using the FX swap market for hedging purposes. But it's really the financial uses of FX swaps, which is much more important these days, and it's grown to a very, very large number. And this is where it's the financial institutions who are using FX swaps to hedge currency exposure. So another use by a financial institution would be by a Korean life insurer who would like to hold a globally diversified portfolio, including US dollar fixed income assets. In this case, the Korean life insurance company would enter into an FX swap, would borrow dollars and invest the dollars in dollar fixed income securities. And because of the swap contract guaranteeing the reversal of the initial exchange of principal, this means that the insurance company is hedged against currency movements. Now, if we look at the total, in fact, it's the FX swap contract with the dollar at one end, which is the vast majority of the FX swap market. It's like 90%. So 90% of the FX swap market is a swap between the dollar and some other currency. This gives you a sense of the importance of the dollar as a global currency. And remember, this doesn't really follow the current account flows. Let's say when the Bretton Woods Agreement was initially signed, the Bretton Woods framework is mostly based on the philosophy that financial transactions are mainly the consequence of real economic activity. So in particular, if you have GDP aggregates, consumption, investment, government spending, exports minus imports, then the financial flows are simply the residual to those macro flows. If we take this more financial perspective, these financial flows are much larger than could be justified by any real economy imbalance in the current account. It shows, in fact, that we should think of the financial system as an overlay on real economic activity, which has a life of its own, and it has grown tremendously over the years. Now, what about the yen carry trade that I mentioned earlier? Well, we can do the same exercise for the swaps involving yen on one side, and that has also grown, but clearly it's much smaller than the dollar amount. So the total amount is really about, it's less than 20% of the total, but it's something that has grown recently. And one of the intriguing questions is, how do we think about the growth in the yen obligations that arise from an FX swap? Now, I said that FX swaps are used mainly for hedging purposes, whether it be a financial or a non-financial company. But as you know, anything that can be used for hedging can also be used for speculation. And one way to think about the use of FX swaps in a carry trade would be to think about the forward leg of an FX swap. In other words, in the initial part of the contract, we exchange principal. So I deliver dollars and receive the equivalent amount in yen in return. And typically, I would keep the yen that I receive in a safe place because I owe yen at the conclusion of the FX swap. But what if I sell the yen, and if I sell the yen immediately in the spot market, then I would be left with an unhedged yen obligation. In other words, I would be having a short position in the yen through this swap transaction. And because the swap market is much more liquid and it's a much larger market, there is a very good reason to think that this has been the main vehicle to build up the short yen positions. And one of the telltale signs is that if we look at the yen, the change in the broad yen index, so let me go to this chart. The broad yen index with the growth rate in the FX swaps denominated one side in yen, then we see this very telltale negative transaction, this negative pattern in the growth rates. In other words, it's when the yen is weak that we see a faster growth in swaps in yen. And when the yen strengthens, this amount falls. So the red line moves in the opposite direction from the blue line. A good way to think about this is in terms of a scatter chart. And you see that there is a negative relationship between the change in the broad nominal effective yen exchange rate and the growth in the total amount of outstanding swaps involving the yen. And what this suggests, and let me just, I can now stop sharing, and I will conclude with some questions for the panel and also some general, I think, reflections that might be useful for us. So the Bretton Woods framework and the view of capital flows as a residual to macroeconomic aggregates rests on the idea that it's the net flows that matter. So it's in an accounting sense, it's the net flows between countries that really matter. However, when we have this overlay of very large gross flows, we really have to take those gross flows and the financial system on its own merit. And if we take that perspective, we get much closer to what I would call the BIS perspective, which is to think of the real economic aggregates, of course, being related to financial conditions, but the financial conditions themselves will have a life of its own, and it follows the rhythm of monetary policy across different places in the world, and the ups and downs, if you like, of global liquidity. And in this sense, it's much more important to think of global liquidity, think of financial conditions in this global perspective, rather than simply an aggregate of individual country financial conditions. So Mark, let me conclude there.
Great, thank you. Thank you, Yun. Let's move now to Jacob. So Jacob, I think one of the questions I have for you was clearly, how can we orchestrate international cooperation? You have been part of, in the 80s, about, I think, the first attempt to coordinate macroeconomic policy with the G7. So give us your experience, and what can we learn for a world that is more divided, more fragmented, and can we orchestrate again this type of policy coordination as we knew it? Over to you. And you can speak over there if you want.
I don't have the Madonna stuff, so I have to go there. Well, ladies and gentlemen, it's a privilege and delight to be here again in Korea. Each time you see a rejuvenation. And I want to thank, like everyone else, the Bank of Korea, the Ministry, KDI, but the originator of it all, Mark Uzan. You asked a question about the system. So many articles started with the title, Reform of the International Monetary System. And you start wondering, for 80 years, everyone is trying to do the reform, and they are so dumb. After 80 years, we did not find the answer yet. I remember when I joined for the first time the IMF as the chief economist, this was in the 80s, and the first paper that the managing director of the IMF asked me to prepare for the board was the role of the fund. And I was flabbergasted. now, 40 years after the creation, you want to define the role of the fund? And I'm told that the current chief economist, 80 years later, also has to prepare the same paper once a year or so. And then you realize the questions remain the same. The answers are changing because the circumstances change. So it is in this regard, it's a live organism that you need to follow and understand what's going on. Why do we need to worry about it? Well, we need to remember that after the failure of the League of Nations before the Second World War II, and the complete derailment of international commerce and trade, the system needed to find a new mechanism that will bring them together and which required some new rules. Hence came the IMF. The important feature of the IMF is that it is treaty-based. And I will have to repeat it again later on, because various formulation and various manifestations of alternatives are distinct from each other by the degree of legitimacy, and the strongest legitimacy that can be given to rules of the game is if it is treaty-based, and that's what the IMF is about, and that's what the Bretton Woods is. But why do we have to worry? We have to worry because of the fact that there is interdependencies in the world. He sneezes, she catches pneumonia. So how do we make sure that there is some rules of the game? In the early days, in the mid-40s, after the war, there was no question who is the hegemon, the United States. So they went together to the New Hampshire hotel called Bretton Woods, were sitting there for 3 weeks, and came out with the draft treaty. There is the illusion that it was a romantic period. We will all be together, we'll go to the same hotel, we will understand each other, and then we will sign the treaty. So let me tell you, it was a very tense period. The head of the delegation of the United States was Mr. Dexter White. The head of the delegation of the United Kingdom, of the Britain, was Lord Keynes. So this was the level of people that were involved. It was not an exercise among small bureaucrats. And they drafted the system. At the end of the discussion, Keynes was very frustrated because there were huge criticisms all over the world, saying this is really nothing, it's not for us. And then he wrote in his memoirs, I'm greatly encouraged by the critical, skeptical, and creeping spirit in which our proceedings have been watched and welcomed in the outside world. How much better that our project should begin in this illusion than that they should end in it. In other words, the Bretton Woods rules came out not exactly with flying flowers, but they started to work as they went along. It's a legal system that has to have the protection of the law. And Keynes was so frustrated by the lawyers, and I hope there are too many lawyers here, because at the end, in the closing ceremonies, he said, if it was up to the lawyers, they would have declared common sense to be illegal. So much for the arrangement of when one started. We are talking about globalization, deglobalization, interrelationship, shoring, non-shoring, and we saw how difficult it is to disentangle interconnected systems, and we have had several papers on this. But one thing remains intact, namely that there are externalities. And if there are externalities, design a way in which to internalize these externalities, otherwise we have a problem. You always need to answer 5 questions that start with W and 1 question that starts with an H. The 5 W's are why, when, where, who, what. Who should do the coordination? What should be coordinated? When should we do that? Etc. And then comes the question of H. How? And here, this is really the menu for each and every program that is put on the table. You must give an answer to these 5 questions and all of this. And why is it the case? Because policymakers are elected at home. Their impact is felt all over, including abroad. So they need to take into account the spillovers or the spillbacks, and with this regard, this is what we are talking about, the system. So how should we implement it? In the mid-80s, the name of the game was 3 countries: the United States, Japan, and in a way, West Germany at the time. This was the G3. It was then expanded to be G5, to be including also, help me out, US, Germany, Japan, UK, and add the other country. Later on, Italy was added and Canada was added. But the question was, how do you manage to do this? The main dramatic exercise was taken in the Plaza Hotel in 1985, where the issue was, how do we means the authorities, manage to bring the exchange rate to the right place? But we need to agree about what is the exchange rate, who should do it, when we should do it, how we should do it. And it was very successful. But if you think about who was sitting in the room, only ministers of finance. There was no central banker in the room. The entire G5 exercise was among Ministry of Finance. 2 years later, they came to the Louvre. And that's where they decided to coordinate not only fiscal policies and exchange rates, but also monetary policy. This became more complicated. And that's where it started to expand. And then it became even more complicated because people realized, but there is also trade. So they brought in trade ministries. And then it became even more complicated. In short, the mechanism for coordination is a very complex one. There is no blueprint. You need to use a lot of common sense, and the idea, however, is dialogue. When you have a dialogue, there are always 3 components in a dialogue: the transmitter, the receiver, and in the middle, the message. And if one of them does not work well, like in physics, like in electricity, the same with economic policy, then there is a problem in the communication. With the increased development of capital markets, the nature of the interdependencies became very, very different. Because you did not only look at trade, but you also looked at financial flows. And financial flows are operating much, much faster. In fact, so fast that they are based on expectations that the reality takes place before the action even takes place, and that's why it gets convoluted. That's where the message must be very, very clear. In the old days, it was believed that in order to succeed in monetary policy, you must surprise the market. Now it's a very different thing. In order to succeed, you must be transparent and clear. There is a story about Alan Greenspan, who was the chairman of the Federal Reserve, who was known to be very obscure. All in all of his press conferences, at the end, after he finished, all the journalists sat together and said, what did he really say? And this was the kind of messages. One day he gave a testimony in Congress, and one senator told him, Mr. Greenspan, today you were extremely clear. And Mr. Greenspan allegedly said, well, if that's the case, then I must have failed. In other words, the clarity of communication is key when it comes to a complex system. And what we have now, in fact, we saw it from the Lehman Brothers crisis, where the interdependencies were much more convoluted and much more complex than what was measured just by the superficial looking at it, that this is one of the things that needs to be very, very careful. Should the system, given that the system is so complex, can we have the illusion of having a simple solution? Here, the dictum that Einstein gave once should guide us. And the dictum is that to each problem, you need to look for the simplest solution, but not simpler than that. Which means you're not going to find it. It's not going to be very simple, and it's the game for professionals, and that's where I want to emphasize. Because time and again, when politicians get into the technical game and try to tell the professionals how markets should work, that's a very dangerous territory. That's why central bank independence is such an important element. Independence means to be protected by the law, but to be guided by the professional compass. We spoke already this morning about reputation, and the way we spoke about it is when we were told that emerging markets in the most recent period have fared much better than the industrial countries. And the reason is because they were lucky to have their crisis earlier, so they could have learned the lesson, so to speak. And I think this is very important, because there was a long period where you were saying that if there is a problem, it's always the emerging markets. It's the debt crisis, it's the defaults and all the rest. This is not the case anymore. In fact, what we have seen just in the last 3 years, that the industrial countries have been significantly behind the curve in many reactions. We have also seen that the problems are always, and I must say again, always coming from failures of risk management in the financial sector. And the issue of risk management is the key, and that's what the role of supervisors and regulators is for. Now, because the system is so important, and we spoke, probably the most important stress today has to do with the relations with China, China and the United States, China and the West, etc. I want to say one thing. The interconnectedness that got developed between most countries in the world and China is so complex and so profound that it is a complete illusion to think that you can unscramble it by a political statement. The damage will be very big. I will make a more stronger statement. The world cannot, under the current circumstances, launch a path of sustainable, stable growth without resolving the stress between the world and China in the financial fields, in the trade area, in the field. I think that there is a tragedy that one of the main dictum of economic theory, that free trade is better than no trade, and that trade is the mechanism to distribute prosperity all over the world, that this dictum is not internalized and ignored by many of the politicians. The only area where the Democratic Party and the Republican Party in the United States agree, they disagree about everything, but the area in which they do agree is about protectionism and how to put walls vis-à-vis China, and they cast it in the context of national security, which may be valid. But I must say, we must recognize that there is a high cost to protectionism, and the question of resilience of a system includes the question of how can we protect ourselves from the damage of protectionism, from the damage of high walls. In the past few years, we have learned that when you adopt policies that are deviating significantly from the long-term sustainability, it's easier at the beginning, but it's very difficult to exit. Look just at the QE that we have had in many of the countries. QE has injected liquidity in an efficient way, especially when interest rates came to the zero lower bound, and the question was, how do you still stimulate the economy? Fiscal spending grew tremendously, so we heard today in the discussion that one of the challenges for the world is the debt problem. So now we have a problem. We have had low interest rate for too long, and we have had high deficits for too long, and hence the debt issue. Fortunately, the low interest era is reversing itself and has reversed itself, and this is key, but we are also learning that what is called QT, that quantitative tightness, is a much more complex way than QE, and we should really make sure there is one important lesson. When you enter a highway, make sure that you know where the exit is, otherwise you don't know how to proceed. So I need to conclude here only to say that there is one important message that I got from Robert Mandel about the property of a system. And I will be just by telegraphic. It is called the N-1 problem. What is the N-1 problem? You have N currencies and you have N-1 exchange rates between them. And I'm not talking now about the entire matrix, just on the bilaterals. Which means that there is 1 degree of freedom. You have N currencies, N-1 exchange rates, 1 degree of freedom. Each system that you design, whatever reform you take, must be informative explicitly about how it uses the degree of freedom. The Bretton Woods original system used that asymmetry by saying that all countries are having the exchange rate between them and the dollar, but the dollar pegs the price of gold. So the degree of freedom was granted to the US to peg the price of gold. Once the price of gold was unhooked, there was a question of what is the system? How is the nth degree of freedom being used? And I think that each system will need to be informative, and you should ask yourself about it. So let me stop here and go back to my seat. Thank you.
Thank you, Jacob. Let's now move on to Andrew. Andrew, Jacob mentioned, the international monetary system, so it's a good transition to ask you to talk about the prospect of the international monetary system. And as I mentioned in my remarks, EZRMB will become in the next decade also a reserve currency. Over to you, please. We cannot hear you.
I am on.
Yeah.
I don't know whether they can hear.
Yeah,
Can you
that's
hear me
good.
now?
Yes, perfect.
Good. Yes, thank you very much. It is such a great honor, and I would like to thank the Bank of Korea, the KDI, Ministry of Finance, and yourself, particularly to listen to two wise men, my good friend Hyun Shin and Jacob Franco, and of course yourself. I think Jacob asked, since Mark, you have been reforming the Bretton Woods system for so long, not quite 80 years, why haven't we reformed it? And the answer, as both Kun-Shin on the flows and the stocks, and Jakob's idea of the system, goes way back to the structural asymmetries of the Bretton Woods system. Now, as you know, 80 years ago, 44 countries, basically led by the US as the rising power, UK as the declining power, decided that they would help Europe recover, essentially with the US accounting for roughly then 50% of the world GDP, world's largest gold reserves, major military power, and essentially the major creditor to the rest of the world. Today, the United States is down to 20%. It still maintains its reserve currency status, but it today owes the rest of the world net 20 trillion, roughly 18% of world GDP, and gross debt of 36 trillion, 1/3 of world GDP, which is roughly equivalent to 123% of its own GDP. So the world now is in a completely reverse situation from the Bretton Woods 80 years ago, in which there was a global hegemon, not just in military, but in economic and financial terms. But today, the drums of war, social inequality, economic inequality, technological inequality, and climate injustice, including natural disasters, are very asymmetric. And so the question that we really need to ask ourselves in posing the question reinventing Bretton Woods and Bretton Woods institutions is, what would it look like 2030 and maybe 2035? That means 5 to 10 years from now. And the answer is the trend of multi-polar or multinodal systems will increase. The world will become even more complex, exactly as Jakob has said. Trade will try to be disentangled, but it cannot be disentangled. Technology will become even more complex, but there are two trends that are fairly clear. The US, unless a miracle happens, will be able to reverse its debt or fiscal deficits. And the second thing is that the emerging markets will continue to grow, but the world's biodiversity will be under threat, carbon emissions will continue to increase, weather will continue to overheat, natural disasters will be worsened. The bottom line is, in 80 years ago, the United States was global hegemon, willing to provide global public goods. Today, it is less willing because of its own financial condition to do this, and without globalization, without global consensus, how do we provide the global public goods? So I think, in a lot of the reform of the, and I don't want to get into these weaponization issues, and whether the renminbi will take over. My view about the global financial system, including the monetary system, is that complex systems do not change overnight. The United States hegemon position on the dollar is for the United States to lose, not for anybody to take over. And the question then is, can the United States satisfy the Triffin dilemma and deal with the N-1, N currencies, N-1 exchange rate issues? The core of the Bretton Woods problem is that national currencies have national interests, but have conflicts with global interests. And that's where we are. Now, let's look at the situation whereby, the global balance sheet is changing. As Jakob says, circumstances change. Therefore, the balance sheet changes and the flows change. The flows are the road towards a balance sheet at a point of time. And Hun Shin has talked a lot about the flows. And essentially, what he was trying to say under the yen carry trade was that the two key countries, basically Germany in the 80s and Japan in the 90s, today are major providers of funding for the dollar, including all the oil-rich countries and also China. So if you try to whack countries for holding the dollar because you disagree with them, the result is de-dollarization trends will increase, but whether they can change that monopoly situation remains to be seen, because that is a fundamental issue. But I really want to concentrate on the systemic issue. And the question is, if we were to be a person coming from Mars, how would a global system finance itself to deal with climate change, social inequalities, technological inequalities, etc.? And the answer is you move, generally in that direction. But the flow situation is completely in reverse. The poor countries are financing the rich countries. Joseph Borrell, one of the more thinking Europeans on the systemic issues, said that Europe accounted for roughly 1/3 of global carbon emissions, but is not funding the rest of the world, particularly emerging markets, on how to deal with climate change. The Promised Loss and Damage Fund is roughly 100 billion a year. The spending on one war, small war in Europe, which threatens to go nuclear, is $100 billion a year. The military defense expenditure is 2.4 trillion a year. And the amount of money according to McKinsey or the United Nations, to deal with climate change and social inequality ranges between 5 trillion to 9 trillion. So that's just the flow every year. How do we finance this with a balance sheet of Bretton Woods institutions that is smaller than 2 trillion? The amount of net lending in official aid to the emerging markets today is less than the repayments and the interest rate payments, as you all know. So it's the international monetary system is a non-system. It's not designed to help the poor or to deal with systemic issues. It's designed to finance the more advanced countries, to finance their objectives, which today the rest of the world is beginning to see does not necessarily align with the rest of the world's interest. And so the question then, how do we get there? Now, I think if you really look at some of the interesting studies, the most interesting one is by your fellow Frenchman, Mr. Zuckerman, that we should tax 2% on the net wealth of the 3,000 richest people in the world, and that may yield an amount of roughly, 200 to 250 billion dollars. That would definitely fund the United Nations, fund climate change somewhat. The other possibility is to use a financial transactions tax, which the Europeans used to be of some policy interest. The estimate being that if you impose a tax of 0.1%, you would get roughly about $140 billion a year. Now, my view is that we cannot reform just on a piece of paper or based on wishful thinking. The best ideas that came out of the pandemic was to increase the SDRs by $650 billion. Now, if the rich countries of this world, who do not necessarily need that increase of $650 billion, were not to donate, but to invest those increase in SDRs in the capital of the World Bank and other multilateral development banks, that on a capital to lending ratio of, let's say, 8, $650 billion times 8 would add $5 trillion worth of new lending, which would go a long way towards to dealing with some of the needs of the emerging markets. So my view is we really need to stop, grandstanding about and beat your chest over democracies versus autocracies, about rule of law, etc., etc. The real issue is that either we go through mutually assured destruction through nuclear war, which, if you really look at some of the wars that are heading, seem to be signaling. We really need to look at climate change or climate heating. We have already gone past 1.5, and it's not just the average of 1.5, but the broad band, so that the emerging markets are, especially the smaller island economies, the landlocked economies, are heating up or facing rising seas much faster than we all would like to admit. So, for example, if you really look at, for example, in Bhutan, they are one of the few carbon negative countries to $5 million carbon tons a year. And they're not being paid for it. In fact, their climate heating, temperatures have risen double the speed of their past. What is the rest of the world helping these countries deal with this? Still talking about loss and damage, not for landlocked small economies, but only for island economies. So my view, therefore, is if we really want to think about reinventing Bretton Woods, let's think about the global systemic threats that we are facing and work together to deal with global fiscal taxation or removing even fiscal subsidies. For example, the current fiscal subsidies on oil and gas, on carbon fuels, globally, if I'm not wrong, is somewhere in the region of $3 trillion. So even simple fiscal reforms, either in terms of taxation or reducing carbon subsidies, would be able to send the world in the right direction. But in my view, the rich countries cannot ignore the fact that it was their rise through technology and colonization that inflicted harm and inequalities on the rest of the world. And since they are rich countries, they cannot go through isolationism or protectionism, thinking that they can ignore the system as a whole. Make America great again, make Europe great again, are basically, slogans to make individuals feel good. But what we should do is to make the world, regenerate its natural resources, cut down, growth speed, and go towards sustainable, equitable development, both at the human level as well as on the natural planetary level. The idea is that, exactly as Jacob said, we went out of ministers of finance to central bankers to add ministries of trade. Now, and today we may even need ministers of defense or national security, because it has become a very complex, interdependent world. And until we think in terms of systems rather than in our silos and blame everybody else, we should look at the biggest culprit, which is ourselves. Thank you very much indeed.
Thank you, Andrew. Thank you very much. Rakesh, over to you.
Thank you very much, Mark. Let me first, of course, thank you for inviting me once again to one of your conferences, to my old friend, Governor Chang Yong-ri, and the Ministry of Finance and the KDI for organizing this and inviting me. I must say that since I retired from the Reserve Bank of India almost 15 years ago, it is seldom that I've been in the tribe of central bankers. And if you belong to the tribe of central bankers, you feel very comforted when you're in the tribe. So this has been a very comforting conference. Let me also recognize my old friend, former Prime Minister Un Chan-chung, who's honored us by his presence. We got our PhDs in the same year, I think in 1976 or 77. So it's a real honor to be here with you, Prime Minister. Now, let me start by saying that Jacob has mentioned a number of times that he was present at the 40th anniversary of the Bretton Woods institutions. Masood said he was there at the 50th. I was actually there at the Bretton Woods conference. Do I look that old? So it was actually I was there in ex officio position that I was economic advisor to the government of India from 1988 to 1976. The first economic advisor in that position was a Britisher called Colonel Gregory. I don't know how Colonel Gregory became an economist, but he's very well known actually. And he represented British India at Bretton Woods. So that's how I was there. So I have won over you, Jacob, and also Masood, that I was there much before you at the Bretton Woods. Now, I was supposed to talk about emerging market resilience, but I won't, because that's too boring now after these very wise statements by Hyun Shin, Jacob, and Andrew Sheng, my friend Andrew Sheng. So I'll give you, so they were sort of flying somewhere here, not even 30,000, 60,000 feet high. So I'll come down to the trenches. First, Andrew talked about big changes that are taking place, and that how the world is very different now from what it was at the time of Bretton Woods, 1944. One really big change that is happening, and the way I often put it is that the center of gravity of the global economy is in the process of moving from the North Atlantic to somewhere in the Indian Ocean, somewhere between Indian Ocean and Pacific, but perhaps somewhere in Indian Ocean. And this is a huge shift which the world is not coping with. For example, everyone mentions the global financial crisis. I'm glad that my friend Claudio said great financial crisis, a little better than global, because what they don't realize is that North Atlantic isn't the globe. It was a North Atlantic financial crisis because, to my knowledge, not one financial institution failed in either Latin America, even Latin America, certainly not in Asia, and to my knowledge, not in Africa either. It was a purely North Atlantic crisis. That just reflects the point I'm making, that the North Atlantic has not realized that the world does not end at the end of Europe. The last shift of power took place about 50 years, about 80, 90 years ago, actually about more than 100 years ago. It started more than 100 years ago, from the UK as the hegemon to the US as the hegemon. But that transfer, that process took 50 years and 2 world wars. And this is something, again, Andrew kind of talked about in terms of the disturbances. So now there is a process of change going on between the US and China. And from whatever projections that exist, despite the slowdown in Chinese growth, Chinese GDP at market exchange rates will equal or exceed the United States within the next 5, 7, 10 years. So this is a huge change. Whereas the relative power in the global, in the Bretton Woods institutions and other MDBs still reflects the 1944 power structure. Just looking at the IMF, the last quota reallocation was done in 2016, but that was based on 2008 data. So in other words, the quota shares today in the IMF, to take one example, reflect the global, the country economic weights of 16 years ago. It is during this time that these huge changes have taken place. Last year, there was a big expansion of the quota of 50%, but they preserved the current share, they preserved the current proportionate shares, which just again reflects the reluctance of the North Atlantic to figure out that the world doesn't just consist of them. So given that this 50% increase took place, one thing we must recognize, there's built-in hysteresis in the quota allocation in the IMF, which is that the new allocation is only on the increment of the expansion of the quota. So that the existing quotas remain in absolute terms, and the reallocation is only on the increment. So now that we've done the 50% increase in the quotas, next time it'll be even more difficult to change overall relative shares. And that once again reflects the reluctance of the West to understand that they're not the only game in town. The problem that this raises, I'm not just being rhetorical, the problem that this causes in the world is of credibility of these institutions in the world. What is the consequence? It's sort of like a kid saying, if you won't share your toys with me, I'll go off with my own. I'll buy my own. So that's what the world is saying, as reflected in various regional financial arrangements. Whether it's Chiang Mai, Europe has almost declared independence from the IMF with the volume of the ESM, which almost is not very far from the magnitude of funds with the IMF. Yet they won't give up their power in the IMF, despite the fact that they've declared independence through the ESM. Similarly, the founding of the New Development Bank by the BRICS, the Asian Infrastructure Bank, of course, and so on, and others. So what is happening really is that with the reluctance of the 1944 powers to share governance in the world, and as Andrew said, look, we are much more interconnected. You can't avoid China. Big difference between the Cold War and now. Because in the Cold War time, the Soviet system and socialist republics were not integrated economically at all. Yet what you might remember is that because of the Cold War, the West was still negotiating happily, in some sense, or unhappily, with the Soviet Union to tone down the Cold War, to tone down, have nuclear test ban treaty, the nuclear treaty, and so on. So there was, because that is where the intersection took place, there was a dialogue between those powers. Now it's much more to understand that the economic independence, as Andrew said, is very much there, so you can't avoid it. Similarly, the weakening of the WTO, now there's huge proliferation of regional trade arrangements and also bilateral trade arrangements. Once again, what is happening? You weaken the WTO, you have more different toys to play with. People are just declaring independence. And by the way, this is connected with the resilience of, I'm talking the G20 emerging markets, resilience. Basically, they've declared independence. That, look, we don't need the Bretton Woods institutions. We can take care of ourselves. After the experience of the Asian financial crisis, the North Atlantic financial crisis, that having learned our lessons, we are then relying on ourselves, whether it is through higher reserves, whether it is through better macro policies, whether it is through better staffed central banks, institutional arrangements, etc. Now, 10 years ago or so, I was on the board of the IMF, 2012 to 15, there was some degree of optimism in terms of global rearrangements of governance and economic power. Now, with the increasing US-China geopolitical confrontation, of course the US-Russia geopolitical confrontation, it is difficult to foresee any kind of rapprochement at this time. However, again, as Andrew said, as you can see, I'm a follower of Andrew for a long time. We've been good friends for ages. And I've always listened to him very carefully and then remember what he said, that there is no choice for the world. If we are to progress, and this is from emerging markets, developing countries, if these two giants fight, we've had it. So it's in our interest to, again, promote multilateralism and somehow find some solutions. There's only one way. The US and China have to find a way to live together. to come to some agreements. As far as, say, the governance is concerned in the international institutions, the Bretton Woods institutions, it seems to me that, say, to take again the example of the IMF, which I know best, that there should be an agreement that the US retains veto power at over 15% of the quota shares, but increase China and other emerging markets according to the economic weights, but US retains its veto power. And to some extent, it seems to me that there is a possibility of some rapprochement like this, but there has to be a shared objective of wanting to live together for the sake of the world, whether it's for climate change issues, whether it's for trade, for economic growth, economic progress, etc. Masood said in his opening remarks yesterday that after the report of the N.K. Singh, Larry Summers committee on reform of the MDBs, that it is a very good report, but he pointed to the difficulties in implementation. And among the things that was reported, there were many, many suggestions in that report. There was a clear need for large expansion of the lending capacity of the MDBs to the emerging market and developing economies, which really means the need to heavily expand the paid-in capital of the MDBs. Now, Andrew went much further than I would in terms of his ambition of allocating 650 billion SDRs to the paid-in capital of the MDBs. But just to give an idea, that there is of the paid-in capital is a leverage of about 10 times in terms of lending capacity. So if you just give 10 billion, if the world put together, not just the United States, if the world put together just pays in about $10 billion as paid-in capital of the US, of the World Bank. It means lending capacity increasing by $100 billion. Again, as Andrew mentioned, looking at the billions and billions of dollars going into Ukraine, what is necessary, going into the Middle East, what is necessary, from one country, the United States, and not even talking about Europe. And what is $10 billion? It just means there is no capacity, there is no intention, there is no intention of strengthening these institutions, because $10 billion is nothing in today's world. It can be $10 billion every 3 years, every 2 years. And it's absolutely essential, given the needs for climate change, huge infrastructure development still to take place in many developing countries, certainly in Africa, industrial development. People talk about trade, as shown yesterday, that the deglobalization hasn't affected trade as much as people talk about. Long way to go. One of the points I make is, if you take ASEAN plus 3, plus South Asia, that's about 4 billion people. Our average per capita income is somewhere between $3,000 to $4,000. Just think, if we grow even 4% a year, the incremental demand for consumer goods will be much larger than the incremental demand that came from the West that fueled East Asia. So there's a long, long way to go, but all of this needs much greater funding and global cooperation. On climate issues, climate finance issues, a lot of talk about public-private partnerships, private capital, etc. But as Ayhan, you showed that 70 developing countries have absolutely zero capacity to borrow, certainly on the private markets. So I don't know why this is an illusion that MDBs keep pushing, that we'll do private sector financing, because they don't want to do it, because the developed countries don't want to fund these institutions. Also, in terms of the, you'll be happy to know, I'm running out of my notes. So, on PPPs also, the record, once again, the World Bank's own studies of even 10 years ago, 15 years ago, particularly in Latin America, demonstrate all the difficulties in doing PPPs. I headed a committee in India on financing of infrastructure in 1997, which proposed much greater private sector participation in infrastructure. But I don't think we foresaw the difficulties in doing it. So it seems to me that these are illusions that must not be marketed by the MDBs because they know better from their own work. I told you that I would, furthermore, as again was mentioned, the weaponization of the dollar, the freezing of reserves, dollar reserves by the US, whether it's Russia, whether it's Afghanistan, whether it's Iran, obviously it tells us, look, don't take this risk. It's the US itself telling you, don't take this risk. Also, the weaponization of SWIFT, again, is telling you, invent your own payment system. So there's huge amount of fragmentation taking place. I'll stop here, Mark. You're looking very impatient. I actually have another paper to talk about the emerging markets, if you like. But the point about the emerging markets, I'll just conclude on that, is what I said earlier, that the data were given by Laura on the one hand, also by Mark, by Ihan, that it is true that at least I'm talking G20 emerging markets, I've not looked at the others in the kind of detail and firepower that Ihan has, but it is true that both in the North Atlantic financial crisis and the COVID crisis, we have done much better, mainly because of the buffers that we have built up in our foreign exchange reserves, improvement in our fiscal policies, improvement in our monetary policies. We did not let our fisc loose like the US and Europe did. We did not, so our inflation was much higher than the developed countries to begin with. So we didn't increase inflation very much. So we didn't have as much to do, which is why we're in much better shape. Thank you, Mark, for inviting me once again. It's been a privilege and honor to be here. Thank you.
Thank you, Raquel. Pablo, please, over to you. You can, whatever you prefer.
Is it? Yeah.
Yeah.
Okay, so thank you. So thank you, Mark. So as Jacob was saying, the questions remain the same, but the circumstances change. And I think through the conference, we are converging in two main challenges for the world economic order. One of them is the global commons or global public goods, climate, security, technology, biodiversity, etc., which imply exogenous shocks and the need for urgent responses, and they can also be simultaneous. So we are in a context of a shock-prone world. And the second one is geopolitical fragmentation, which is not only the US-China divide, but also the emergence of the global South as a counterweight to the Western, traditional Western alliance. I think, so we're not longer in the ideal world that we thought we were at the beginning of the century when we were talking about the end of history and the triumph of liberal democracies and the Washington consensus. That's not a reality anymore, and we have to deal with that. I think I will add a third challenge, which is also related to the former two, which is polarization. So traditionally we had center-left or center-right governments for which the margin of economic and international relations policies was relatively narrow. Now we are in a context where politics are polarized, and we can really have pendular changes in economic and international relation policies that affect fragmentation, etc. And this is very much related to the issues of inequality that Andrew was mentioning before. So in this context, we have two main needs. We need to have cooperative solutions for the global public goods, because countries cannot do it alone, first. And second, we need to mobilize a huge amount of resources, again, along the lines that Andrew was saying. And I think that the solutions have to be guided by two main principles. The main one is you have to be pragmatic and I think political. There is some conversations about the need of depoliticizing international institutions, giving them to technocrats. I think I don't agree with that. I think political solutions are needed. There has to be a buy-in by the public. Technocrats are good at understanding the mechanics of the automobile, but they're not good drivers in convincing the general public that they have to go into a certain direction. And the second one, like Raquel was pointing out, we need shared objectives. So we have to avoid imposing Western values, so to speak. So we have a reality of different values. Let's just focus on the shared objectives, and the main criteria being spillover effects, the sustainability of the international financial system. So this means that we might not have to reach solutions that are not necessarily multilateral anymore. So we might have to find second-best solutions like the WTO is trying to do with plurilateralism, that is the coalitions of the willing, or we might need to find solutions like the Paris Agreement, which is basically a concerted unilateralism, but commitments by the countries that are added up for global solutions, or if we have unilateral decisions in the international economic system, then they should at least follow some standards and some rules and some transparency, and they should be explained to the rest of the countries. Now, in this context, and focusing on the IMF that you asked me to focus on, Mark, and I think the IMF can play a very important role for many reasons. First of all, that it is an institution that it is there. Okay, so it is costly to create an institution to deal with these new issues, like, for instance, climate, and we just might not have the time to do it. And second, because the IMF has the needed characteristics. As an institution with universal membership, it has I think good credibility, although some people question it. It has the resources. It has a signaling comparative advantage, and it deals with finance ministers and central bank governors, which are, the decision makers in many of the instances. So there is a scope to reform the IMF in different ways, again following this pragmatic approach. And I want to throw in the disclaimer right now. So these are only my views, not the IO, certainly not those of the IMF. So if you focus on the four main policies of the IMF, the first one, surveillance and capacity development, I think Masoud was talking about a debate there is an ongoing debate between those that want to focus on the core policy, which is fiscal, monetary exchange rates and financial policies, and those that are more defending so to speak, newer policies. I think that we need to take a step back and make it clear that the so-called core policies, like I think Jacob was mentioning again, they were not core in the past. So the IMF did not deal with exchange rates until the fall of the Bretton Woods system, and the IMF did nothing about financial sectors until the end of the 90s, following the Mexican and Asian crisis. So in this new context, and I think climate is an existential threat, the IMF is dealing with a unique challenge, which is climate change. There is a strategy for climate change that was delivered in 2021. In 2021, the IMF also established that sustainability, and not only fiscal and monetary stability, sustainability, it is a goal and an objective of the IMF. So I think there is a scope to further strengthen the work of the IMF on climate change, and it probably there is a scope to even mainstream it the same way that we did it with the financial sector, in order to shield it and protect it from political polarization and changes. And we know that the views of countries on climate can diverge very quickly depending on who's governing. The second one, the lending policy of the fund. So again, Masoud was saying, okay, the resources are there, but countries are not using them. So here, I would just highlight two important success stories. One is the emergency financing during the COVID-19, very strong success story, over 100 countries receiving money. The advantage of it was very fast delivered, and it had no conditionality. The second one is the Resilience and Sustainability Trust, which is financing basically climate challenges. So it's important because it has a positive signaling. The countries like it because they want to signal that they are taking the necessary reforms to address climate change. What's important about the RST is that in order to get it, you need to get a conventionally financial program for the fund. So it's actually acting as an attraction for countries to get involved in the fund. So I think there is a scope for reviewing the lending facilities of the fund with the perspective of maybe improving emergency financing because we are in a shock-prone world, maybe thinking about longer financing term instruments, and that's the attractiveness also of the RST, and certainly thinking about facilities that will help catalyze mobilizing resources in a context of much needs, especially for climate. The third main area of policy of the fund is the resources. I think the fund has, since the global financial crisis, it has reacted quickly when they have needed resources. They they multiplied by 4 the resources after the global financial crisis. They now have 1 trillion. They're not fully used. They deliver, the fund delivered the 650 billion SDRs during the COVID crisis. I think here I tend to side with Andrew. So there is a need maybe to reform the SDRs to be able, they are distributed according to quotas, so they mainly go to advanced economies. They don't use them. And so there are many discussions on how to mobilize them, maybe through development banks, maybe through the RST in the fund. But maybe you just have to change the whole instrument itself, because the problem they have is that they are reserves that go to the central banks. So there might be a way to deal with them. There's even the possibility of using them like unconventional monetary policies are using them in investing on secondary markets on debt. And finally, the fourth one is governance. So I think there is the historical discussion, and Rakesh was talking about it, about quota realignments. That's long overdue. We all know the cases. Of course, the most misaligned countries is China. India is also misaligned. Korea is a little bit misaligned. So I think we are now going to start the 5th discussion in the last 20 years about formulas. It might work this time. No, you never know. No, you never say never. But we had a good solution in 2006 and 2008, which is ad hoc increases to, just to correct the misalignment of the most misaligned countries. And there are some countries that are misaligned, whatever formula you use, whatever variable you use. And that will basically mean that the countries that are overrepresented, including the European Union, will have to reduce their quota, and other countries that will have to increase it. But there are also some other governance reforms that are under discussion now that I find particularly interesting. Of course, there's also the debate of the election of the managing director. It shouldn't be necessarily a European. I think that's a low-hanging fruit, and it will happen probably in the next election. There is an ongoing debate of the possibility of recovering the council, so to make political decisions. That was also already considering the Articles of Agreement, and I think there is some issue there. Although here, I think what's important, there might be some room for trying to align better the IMFC and the G20. The G20 is a better animal, it's a better political animal, because they can make better decisions, and they don't stop at finance ministers and governors, they go all the way up to heads of state and government. So some alignment between the IMFC, if it were to be converted in a council of decision making, and the G20 might be useful. And also there are some governance issues. If you do establish it, maybe you need to separate the roles of staff and the board, the same way that you in companies, separating the CEO from the chair of the council, of the board of governors. So something similar to what the European Union has between the European Commission and the European Council. There are some other issues which I also find interesting. Maybe can we have directors that are independent and represent the views of CSOs or think tanks? Because the problem with the current directors is that they are guided by country interests, but there is no an independent director that can shed light on global needs. Maybe I'll just conclude here. I try to be fast because I know that the time is running. Let me just recover a very famous quote by one of the founding fathers of the European Union, Monnet. He said, "People only accept change when faced with necessity, and only recognize necessity when crisis is upon them." So the problem of all these changes is that the fund has been very successful over time to react to crisis, but it hasn't been that successful in planning ahead. And these kinds of reforms do require some political will and some planning to really change, because, and again, going back to climate, this is an existential challenge, and we don't have time to keep discussing and thinking about it. Thank you again, Mark, for the invitation.
Thank you very much. I received some messages that we are running out of time, but if there is one question from the floor, please do so before we come to the conclusion. If anyone wants to make questions, comments. Yes, over there. Please introduce yourself.
네, 안녕하세요.
Good afternoon.
혹시 이거 영어로 해야 돼요?
So, good afternoon. I am working in a financial institution, and I have studied quite a lot about the Bretton Woods system in university. And now it is a great honor for me to be listening to the discussion on what I had been studying for the past 4 years. So then now my comment is, so this is a question to Dr. Shin and also to Chairman Jacob Frankel. So then, if I may speak about, let's say, regarding Japan. Now they say that Japan is prone to earthquakes, and if such earthquakes are to occur, then they say that Mrs. Watanabes are likely to withdraw their currency from emerging countries. So once that happens, then the emerging economies now they were able to hold on because the debt had been deferred. But then if such or there to be such capital outflow, then they might have to go to the IMF. So then if such a case, then what can the IMF or the Bretton Woods system can do for them? And then my question to Chairman Jacob Frankel is that now for the next few years, and I believe that what is going to be the most important is going to be water. For example, because of water stress or drought. So in some of the African countries, especially inland countries, then because of lack of water, there are no jobs, no food, then they would have to move on to Europe. Then there are all these fights over jobs. And then the conflicts could spill over to Saudi Arabia or to the Middle East. And then perhaps that could also spread to other countries as well, like Northeast Asia. So if that were to happen, then under the Bretton Woods system, what can we do? And also, yes, we do see the US and China tension, but then let's say if the US were to reallocate their troops from Europe to Northeast Asia, so if that does happen, then if the US troops were to be stationed in Northeast Asia, then let's say the India, Indonesia, Malaysia, now these countries, of course, their economy could continue to grow, but there could also be a lot of conflicts. So then again, what can be the solution out of this?
So, sorry, because Mr. Chin already left, so we will not be able to answer your first question. The second question, Jacob, you want very clear. You want to take the second one on the US-China? Oh, huh?
I only followed part of the question which had to do with water.
Yes.
And I can only say two things. Number one, many of the areas, when you speak about the Bretton Woods organizations, they are part of a broader range of institutions which is called the UN system. And the UN system includes in it not just the World Bank and the IMF, also lots of other kind of things. And many of the areas that you were talking about really do not fall in the preview of the IMF, for example. But I will not be bureaucratic about it and only say that indeed the issue of water is a critical issue, and the only two solutions that I'm familiar with is desalination, and this requires, there are technologies for this, and the second, conservation. For example, the irrigation systems that have been developed, the so-called drip irrigation, introduces extraordinary efficient technology to make better efficient use of a given amount of water. But so we are really talking about two issues. Hey, how to produce more water, this is the desalination, for example, and second, how to conserve in water, and this is the irrigation. But I would also say it's not exactly my field of expertise, so I will defer to my colleagues if needed.
Okay, Jacob, thank you very much. So this time to conclude, because I know we are running out of time. Thanks for all the panelists for great panel, great conversation. Thanks again for KDI, Bank of Korea, Ministry of Finance for hosting us here for the last 2 days. I think it was a very good conversation. And hopefully your working group discussion will follow what has been said over the last 2 days. On our side, we look forward to seeing you during the annual meeting of the IMF and the World Bank to be continued. Thanks again.
Thank you very much, Executive Director Mike Wuzan, for moderating the session. And I'd like to extend a sincere gratitude to all the speakers who provide a valuable insight and idea for fostering a financial stability. And we hope our participants had valuable time and meaningful time. We would like to also express our heartfelt thanks to everyone who attended in person and virtually from various locations around the world. Your support and dedication and participation made this event a success. Thank you very much. On that note, we officially conclude the 2024 Global Economy and Financial Stability Conference. It has been my great pleasure to serve your MC. Thank you very much, everyone. Have a good rest of the day. Thank you.